Good morning, friends. I welcome you for this today's webinar on tax audit. And before start of the program, I want to wish everyone happy Navratri and happy Dashera in advance. So tax audit is really very important job since 1985 we are doing, and this is an important source of revenue as far as we chartered accountant are concerned. And tax audit, always we are seeing that every year some changes or other changes are there, and we are facing it various issues as far as the tax audit is concerned. So today that what we are going to discuss. But before going to topic, we have with us the young and dynamic chairman of WIRC, CA Lalit Bajaj, who has worked really very hard during this pandemic time also. So I request Lalit sir to share his views.
Thanks, Manoj bhai. Expert on the subject CA Piyush Chhajed ji. In absentia CA Manoj Pandit ji. My co-regional council member Manish Gadia. Coordinator for the program CA Malvika Mitra. Seniors, friends and colleagues. On behalf of WIRC, I welcome all of you in this August gathering, wherein we are supposed to discuss on issues and amendments in tax audit. As of now, I think so for any kind of conversation with any chartered accountant, tax audit is one of the subject wherein it is on the top of our mind. Let me tell you on behalf of ICI that ICI and WIRC has proactively taken ahead and represented to a ministry about the requirement of extension of various due dates, and we are hopeful that it will be extended sooner. As far as today's subject is concerned, I will leave it to the speakers because they are experts on the subject. When we talk about audit, let me tell you one thing, that WIRC this year has come out with couple of publications. One is Key Audit Matters, wherein we have listed all the reporting, relevant reporting made by various listed entities in last 12 to 13 years in with a search engine facility, and it is there on WIRC website. Second, we have come out with a compilation on COVID related disclosures. I thought so both these publications are very relevant for all those who are engaged into assurance services related to tax audit. One more publication under the leadership of Manish bhai, we are working on the same, that is litigation related processes, and we will be sooner announcing, and it will be a e-publication and will be launched on WIRC website, so all the members can take benefit of the same. Friends, as far as the basic requirements of various sections of Income Tax Act is concerned, we are coming out with some basic audit tools which will really help us whether a particular establishment or entity covers under particular section and what are the compliances they have to undergo. So we are coming out with those tools, and those tools will be available on WIRC website. Within a week or 10 days, we will be uploading those tools on our WIRC website. So you all can take the benefit. Over and above this, we understand today is a very tasting time. But in this tasting time, this is a sort of a stopgap arrangement wherein we can focus on some of the non-core areas which otherwise we are not able to focus much. So when we talk about networking, I think each and every chartered accountant, each and every small and medium practitioner is really concerned and is significantly thoughtful about how we have to go to next level. And networking is one of the move by which you can go to the next level. And I am happy to share with you that WIRC under the label leadership of Manish bhai have started with this networking initiative, wherein we have started with networking help desk, and we have completed a couple of help desks in last month, and members have taken the benefit. I would request all the members do write to us at wirc@ici.in for any networking related clarification or issue, so that you can be part of the live help desk, which will be announced in next say couple of days, to be held in next 10 to 15 days. So with this, I believe that you all might be taking benefit of various initiatives of WIRC. I look forward for more and more participation and more contribution from all of you in all the initiatives and activities of WIRC. I once again welcome all of you and look forward for a very happy learning. Thank you.
Thank you, Chairman, for your kind words. We have with us CA Murtaza Kachwala, Secretary WIRC. So I request Murtaza Bhai to say a few words. Over to you, Murtaza Bhai.
Thank you, Manoj Bhai. Really a very good program, and on a appropriate time. I would urge like members to also consider one important element, and that is the basic foundation, which is a standard on auditing. And like for tax audit also, it is like it is utmost important that we have samples properly, we do the analytic procedures, we have a working paper, and of course an engagement letter and a representation letter. So I would urge all the members to also take that into account. And that's it from my side. Manoj bhai, over to you. Thank you.
Thank you, Murtaza Bhai. I also recognize the presence of next speaker, CA Manoj Pandit, and our coordinator, Malvika Mitra. So I will not take much time, and we are eagerly want to hear Piyush Chhajed sir on the issues on tax audit. But before inviting him, I just want to tell brief about him that Piyush Chhajed ji is a partner in Chhajed and Doshi firm at Andheri, which was established in 1964, and he is in practice since last 20 years. He is specialized in direct and indirect tax appellate proceeding and arbitration proceeding, and he is a regular speaker on direct taxes at various fora. He was co-opted member of Strategy, Prospective Planning and Monitoring Committee of ICI in the year 1922. He was member of study group formed by ICI for revision of publication guidance note on tax audit under section 44 AB of Income Tax Act 1961 in the year 2020. So he will give that insight also to us along with the issues about the guidance note. He is a special invitee to Central Council on Direct Tax Committee in the year 1819, co-opted member of Government Accounting of Committee of ICI in the year 2009-10, and he was also co-opted member of Board of Studies of ICI in the year 2004 and 5. At WIRC also, currently he is a co-opted member of Direct Tax Committee of WIRC, and he is a co-opted member of Direct Tax Committee since last year also in the WIRC. So at WIRC also he has guided us, he has served us at WIRC at various capacity, at various committees. At Chamber of Tax Consultant also he is a member of Direct Tax Committee. He is a member of External Advisory Committee of RBI for Asset Risk Reconstruction Company 2019 onwards, and he has contributed to a WIRC publication on Vivad Se Vishwas scheme 2020 and reviewer of FAQ on charitable trust published by JCF. Apart from this, he is also a honorary vice president of JCF and independent director of Wimplast. So with these few words, I present before you CA Piyush Chhajed. Over to you, sir. Piyush bhai, your volume.
Thank you very much, Manish bhai. Thank you very much, Manish bhai. Thank you, Chairman sir. Chairman sir, Secretary Mr. Murtuza, Manish bhai, Coordinator, my co-speaker CA Manoj Pandit, all the distinguished participants in today's webinar. I thank you first of all, WIRC, for inviting me on this topic, which is a hot topic of today. And it is at very appropriate time also, because I believe that extension will happen. Because if extension does not happen, then this timing would not be good. Because we are at the last week. If the extension do not happen, I think so we have only 7 days to go for the tax audit. But I'm sure that extension will happen. As everybody, Institute has made a representation for the extension up to 31st March, the written filing and audit date up to 29th February, basically 28th February. But I don't know whether the government will accept that request. But at least some extension should come in, maybe a month or 2 months. Let's wait and watch. Meanwhile, as we were discussing just before the session started, there are a lot of writ petitions have been also been filed by various bodies, various associations all over India, and they are also been lined up for hearing in the coming week. So there would be some outcome in those cases also, which may compel the government to do a extension. But as it is remains, as we are aware, that extension is always the last date exercise, last week exercise, last 2 years, 3 years we have been exercising this. So for us, it becomes very important not to wait for the last date, though this year is a COVID situation, which is a special situation. And there are a lot of, after being a COVID situation also, there have been a lot of amendments also. A lot of new sections have come in. And there is also amendments in 3CD also, for which I've been told that yesterday or day before yesterday, 2 days before, the utility has come. So obviously to gear up with that, the professionals will require time. We'll have to look into it. There is an instructions issued by CBDT which runs into 700 pages, I've been told. Even I could not look into it. What does those instruction contains and how it will affect? But definitely to look into it, we require a time. Uh, as an tax auditor, as an auditor, it's very important for us that the quality of the tax audit is maintained, irrespective of the due dates. I never consider a due date unless and until you are giving a quality. It's not important at all to file a tax audit report on 31st October if I am not doing a justice to the tax audit which I'm doing. I have to ensure that all my auditing standards are being complied. I have to ensure that the tax audit which I am filing and the deductions or the informations or the allowances which I am claiming is been allowed by the assessing officer. And it becomes very important for us. You would be aware that the tax audit is a very important document in case of wherever there has been a litigations for the additions made by the assessing officer. Time and again, the various councils have been arguing that my accounts are audited, and once the accounts are audited, generally the assessing officer should not tinker with it unless and until he has a very specific issue or is able to pinpoint out some discrepancies in my audit report. So that is the status of this tax audit report. The tax audit report is basically for determining the computation of total income. It is for determining the taxable income. So that was the
Piyush sir,
purpose. So keeping that
Piyush
mind
sir,
in purpose, it is very important for us. Yes, please.
Piyush sir, PPT शेयर करिए ना सर.
हाँ जी मैं करता हूँ. I'll just. Can you everybody see my screen? Is my screen visible?
Yes sir, yes sir, yes sir, yes sir. Sir full screen करिए ना इसको sir.
हाँ मैं करता हूँ. Is it fine now?
Yes sir.
Perfect है पीयूष भाई.
Okay. Okay, thank you very much. So it's very important for us. I was on it that the tax audit should be taken up seriously. We have to maintain a quality. So the reports which the department has always put or the judiciary has put in the audit reports remains it. As I was mentioning it, that a lot of times the judicial precedences are there, wherein the courts have held that the once the accounts are audited, ITO cannot do anything. He is not supposed to tinker with it without an exceptional circumstances. So that is the level of the audit report which has been accepted by the judiciary. So keeping this in mind, it becomes very important for us to do our work properly, responsibly, and do it correctly. And that's why whenever, if I would put it to, when I am in my office, I always tell my tax audit team that please do not worry about due dates. When you are doing audit, you should never keep it in mind that the due date is on 31st October or it is the 30th September. You have to ensure that whatever I am required to do under this particular audit, while filing up 3CA, 3CB, 3CD, while complying with auditing standards, while looking into my samples, I ensure that this has been done properly, irrespective of what the due date is happening. I do know you is concerned. If you are not filing tax audit report, there are penal provisions. But mind me, if your tax audit report displays the quality reporting, I'm sure that penalty can be still on a reasonable ground can be waived by various judicial authorities. But the quality of tax audit cannot be compromised. So keeping that in mind, it becomes important for us to keep understanding, keep learning. Though the tax audit is a annual subject, every year it comes. Most of our chartered accountants practice is from the tax audit. Majority of the practices in the, of course, even in Mumbai city or even outside Mumbai city, rural areas is derived from the tax. So therefore, tax audit becomes an important practice. It also becomes important to meet the deadlines so that our clients do not we do not have to face our clients and they would not come back to us that why the deadlines are not met. But of course, meeting a deadline is not our own responsibility. It is also the client's responsibility to ensure that it is provided well in time. Now, today's session, as mentioned, would be divided into two parts. I would try to cover important issues in tax audit. I've tried to cover in the presentation 8 to 10 important clauses, which I thought it requires a mention, it requires a refresh. Every time I go to do a tax audit, I should keep these things in the mind and I should always test that these things are compliant. So the important issues have been covered. I believe my co-speaker would be also taking into these amendments and others by analysis. So I'll start with my presentation. What is the objective of the tax audit? So, as I said, tax audit is the most important. So, whenever I start a lecture on a tax audit, I always try to refresh on the objective of the tax audit. It is important why we have the tax audit, why the tax audit is required, why the tax audit is done. Then we will be able to do a justice. The objective of tax audit was for examination review of accounts of any business or profession carried out by taxpayers to ensure correctness of implementation and proper compliance of tax provisions envisaged under the Act. So, if you see, the main objective is to ensure implementation and compliance of tax provisions and enable the tax authority to determine the income or for verification and assessment. So it becomes important for us to be updated on the tax amendments, updated on judicial rulings which keep on coming on the various tax provisions, which will also help us in reporting in the Formula 3CD. So it goes beyond that. As a tax auditor, you have a technically two. Uh, I think so my job connection has lost.
पीयूष सर पीयूष सर
Yes, voice.
नेटवर्क थोड़ा स्लो आ रहा है क्योंकि आपका आवाज बहुत कट रहा है सर कैमरा आप स्टॉप कर दीजिए सर
Stop the video. I think better.
यस यस यस
मैं वीडियो एक बार स्टॉप कर लेता हूँ तो बेटर. Now it's better.
थोड़ा कंटिन्यू बोलिए मैं बताता जो हाँ सर चालू करिए सर कंटिन्यू चालू करिए.
Yes. So the objective, as I mentioned earlier, I'm sorry there was some network connection. I'll just reconnect it. So the objective of tax audit is that the computation of income can be drawn properly. So as a tax auditor, we have a two-way responsibility. Unlike statutory auditor, where you also have a two-way responsibility with Companies Act at the one place and with my auditing standards and accounting standards. But as a tax auditor, you have to comply with your auditing standards irrespective, number one. You are certifying your financial statements, so you have to comply with accounting standards too. And since you are actually reporting in form number 3CD, which helps in correct determination of total income, it is also important for you to be updated on Income Tax Act. So as a tax auditor, the responsibilities are vast. All the three provisions you need to look into it and you need to be updated on it. What is our responsibility under tax audit? Our responsibility is to express opinion on the financial statements. The financial statements may have been audited under the Companies Act, or it may have been audited, not audited under any particular act, and only as a tax auditor you would be auditing the financial statements also, wherein you would be issuing a tax audit report and form number 3CB. And if it is audited under other act, you will be issuing it under 3CA. So our responsibility is to express our opinion on the financial statements, for which obviously you are required to obtain a sufficient and appropriate audit evidence in accordance with our auditing standards, and also verify the statement of particulars required to be filled under section 44AB. As you all know that form number 3CD has to be certified by us along with 3CA or 3CB. Now the statements or the information given in the 3CD has to be properly verified. I've been seeing during my previous experiences with a lot of audit firms. In fact, our audit team a lot of times fills up the form 3CD, collates the data with from the client and fill up. Technically, as an auditor, I would have suggested that the complete form number 3CD should be asked by the client to be given us, and then the verification exercise should be done. So instead of preparing a 3CD, you are verifying the form number 3CD. But in the practical times, a lot of places where the clients are small and they do not have an advocate staff, I've been seeing the complete collation of data, a preparation of data in the format required is also been done. What happens during that process is basically we lose on our auditing standards. We are only actually complying, getting the data and reporting it. We are not actually able to concentrate on what documentation I should preserve for purpose of reporting. What should be my backup paper if I'm reporting in any particular clause? What should be the type of evidence and documentation my working paper should contain? So generally, if it is possible, I know when there is a small clients, it may not be possible, and you have to give you also have to give them a support in compilation and information. But at the same time, you should not be lost that verification is more important, and there should be an independent verification by your own team member if somebody is collecting data, and ensure the working papers are in accordance with the tax audit guidance and as well as auditing standards. Coming to an applicability, of course, recent amendments, as you everybody know, I'll just try to cover it in short. The turnover limit has been increased to 5 crores, 44 AB. Initially, the turnover limit was above 1 crore. You had to do an audit unless and until you are opting for the presumptive tax under 44 AD up to 2 crores. If you were opting and you were offering 8% or 6%, then you were not supposed to do an audit up to 2 crores. But otherwise, above 1 crore, if you're not opting for 44 AD, audit was compulsory. Now this limit has been increased to 5 crores, subject to certain conditions, which talks of that your cash payments or receipts should not exceed of 5% of total receipts or payments. If you can see on the screen, I tried to compile the holistic picture that what would be the situation if the turnover is less than 1 crore, if it is more than 1 crore, how the audit would be applicable. So if your turnover is less than 1 crore, 44 AB is not applicable, no tax audit. If after, unless and until, if in previous financial years you have opted for the benefit under section 44 AD, that means you had opted for a presumptive tax and you had offered a tax rate based on 6% or 8% in the previous financial year. And for this year, if you don't want to opt for the 44 AD provisions or for the presumptive tax, then the audit becomes compulsory in those particular case, even if your turnover is less than 1 crore, subject to your income is exceeding the maximum amount chargeable to tax. So therefore, only that audit would be applicable in case of less than 1 crore turnover, only if your income is exceeds maximum amount chargeable to tax. And two, in some previous financial years, in the previous financial year, you had opted for 44 AD and you do not want to opt for 44 AD. Coming to a next step, turnover is between 1 crores to 2 crores. Option to opt for 44 AB or 44 AD, you have an option. If you opt for 44 AD, technically no audit is there. If you are not opting, and if you are opting for 44 AB, there's no presumptive tax. Audit is applicable between 1 crores and 2 crores. In the previous scenario, obviously this limit has now gone to 1 crore to 5 crores, which is subject to now if your 5% of your receipt or payment is not by way of cash. So supposing, I'll come into the next slide wherein the cash payments, how the cash payments and cash payments will be determined 5%, because I know there are a lot of issues, a lot of controversies, a lot of different views which are happening that how the 5% of the receipts and payments has to be taken off. I'll come into the subsequent slides. 44 ADA, everybody knows, applicable to a profession like a chartered accountant firm, like a lawyer firm. So if your turnover is less than 50 lakhs, and if you opt for a 44 ADA, that is a presumptive tax, and offer 50% of the gross receipts as your income, then you need not do an audit. If you are not opting for a presumptive tax and you want to offer less than 50% of your profit, even if your turnover is less than 50 lakhs, then obviously you will have to do an audit. So there is no benefit available like a 44 AD to a professionals, wherein even if your turnover is less than 1 crore and you are offering less than 6%, you are not supposed to do an audit. But in case of 44 ADA, if your turnover is less than 50 crores and if you're not offering minimum 50%, then the audit is compulsory. More than 50 per lakhs turnover, audit is compulsory. Now, interpretation of 5% of total receipts or payments. I've come across a lot of queries in our WhatsApp groups wherein all the professions are there. Every day now and then this has been discussed. What is total receipts? What is total payments? Everybody has a different views. Somebody says once you talk of total receipts, then I should add up total receipts completely. For an example, even a balance sheet item. So if I sell a fixed assets also, while calculating 5%, though those may not be considered as your turnover, balance sheet items, sale of fixed assets are not considered as turnover for the 5 crore limits. But for arriving at 5% criteria, I should add. So this is the view which are going on. Certain people say that no, 5% of total receipts or payment should be looked in from the point of view of the expenditure incurred, because ultimately what I am claiming during the particular assessment year or a particular financial year is the expenditure incurred. So keeping the controversy as it is, in my view, I would restrict this 5% of total receipts or payments not to the total receipts or payments, but to only to in respect of expenditure incurred during the financial year. So if the expenditure is incurred during the particular financial year, in those cases, wherever those expenditures have been incurred by way of cash payment, I would apply that particular ratio in my view. Though there are different views happening, but in my view, I'm taking this view. And coming to second issue, the reason for taking view, let's take an example. If that is an objective that the total receipts or payments has to be taken, let us presume that I have a turnover of 1 crore rupees. More than 1 crore, because that's 1 to 5 crores 44 AB. So I have a small turnover of 1 crore 5 lakhs, 1 crore 10 lakhs. I am a retailer wherein everything is a cash receipt. Everything is a cash receipt, 100%. If I have to interpret total receipts or total payments from a perspective of a complete balance sheet items, then I can eventually arrange my transactions in a particular manner wherein I can receive a loan and repay a loan for 10 times of a 50 lakhs value or a crore value and do a 20 crore transactions and come out of the clutches of 5%. And that is the thought process which gives to my mind that according to me it should be in relation to an expenditure record, though the words used are loosely like total receipts or total payments, but the ultimately objective of this particular tax audit is, or increasing the limit is, to discourage the cash expenses. As far as balance sheet items discourages, like the loans is there is already a sufficient provision to discourage those provisions under 269 SS, 269 T, and now 269 ST also. So there are sufficient discourage for other balance sheet items. So I don't think so this should be considered over here. So my view would be up to the expenditure incurred during the year. 44 AD, as you all know, computation of income on presumptive basis. I'll just move fast on this. How to calculate gross receipt or turnover for the purpose of the limits. As you know, it is 1 crore or 5 crores. You need to calculate the gross receipts or turnover. So our guidance note, if you refer to our guidance note issued by Institute of Chartered Accountants of India, on tax audit, which Manish bhai mentioned earlier, that it is under the revision also. And I was one of the part of the committee that the revised tax audit guidance note should be coming any point of time. And it was almost under the preparation to come when meanwhile further more amendments have come in last month. I think so those would be also incorporated, and the revised guidance note on tax audit will be coming in this sometime. Anyways, if you look into a turnover, what it is, how the turnover should be calculated, whether what will be included, our guidance note gives a quite a very good guidance, which I have actually collected from here. So if you see, in case of guidance, turnover shall be aggregate amount for which sales are made enterprise. The question is whether professional is the gross receipts, because you are following a cash basis. There's no concept of turnover. For you, professional turnover is the gross receipts only, and the wordings used are also gross receipts only. The question is what happens to an advance receipt in case of a professional, whether those can be included in a turnover. Advance receipts for which are yet to be rendered shall not be form part of gross receipts till the services are rendered. There is somebody, what, because we are following a cash basis, even if you have not provided the services and you receive an advance receipt, like in an audit fees, it happens. A lot of the clients actually uh, deduct TDS portion on 31st March itself. And because the TDS is detected, but you are not booking a revenue because it's a cash basis. So certain people do recognize the revenue only to the extent of TDS, because receipt of TDS is as good as cash receipt, amount received, and it should fall part of the gross receipt. The question arises over here, because you have not provided services, even the audit would have not started. Tax audit fees, you start the audit in September and October. So whether this amount of TDS which has been credited into your 26 AS, whether it would form part of turnover or it would be treated as advance receipt. According to me, it is an advance receipt. Let's take an example. If ultimately you are not able to do a tax audit for whatever reasons, August or September, and that TDS has been deducted, so a situation may arise that you are not entitled to a TDS at all. In July, after making a provision and deduction of TDS, somewhere in August or September, you resign from a tax audit, or some tax auditors have changed. So you may not be able to provide any particular service at all. So in my humble view, any TDS received would be in nature of such advance receipt. So though I am following a cash basis, this advance receipt should not form part of turnover as far as 44 AB is concerned. In case of agents, turnover shall include amount earned as a commissions, indirect taxes, sales tax, excise duty, now GST, whether they should be included. No, they will not form part of the turnover. Discount allowed in the sales invoice, which is in nature of trade discount, should not be allowed be considered as forming part of turnover. Even under the indirect tax laws, the discount which is allowed on the invoice, which is in nature of the trade discount, is not considered as a form part of turnover, and you get a benefit also, as to best of my knowledge, under the GST. Cash discount. Cash discount whether can be reduced from the turnover? No, it cannot be. Cash discount is in nature of financing charge. It has been allowed because the early payment has been made. So it cannot be reduced from the turnover. Turnover will continue. Sale proceeds of fixed assets would not form part of turnover. So there are many other special rebates allowed. Price of goods returned should be deducted from figure of turnover even if the return sales. So these are the, I've tried to cover this in the accounting side. I'll not go into detail because this is more or less now determined, but I thought it would be appropriate to refresh what does this turnover is, because when the limits have increased from 1 crore to 5 crores, it becomes important for everybody of us to check, because there may be a deadline cases that whether the discounts needs to be considered, whether sale proceeds of property needs to be considered. And moreover, it becomes very important in today's time when there is already a two views going on, that how the 5% of receipt would be calculated. But please keep it in mind, calculation of turnover and 5% of receipt of payments are completely different. A turnover criteria is different. It is not similar, wordings are not similar, turnover is different. 5% gross receipt and payment is considered. Like if my sale happens, but because of my logic, what I am putting it is that you should go on the basis of expenditure income. So if my turnover, which is reported in my P&L, is it by form of cash receipts exceeding 5%, then only I would consider it that I am eligible or not eligible. And I would not consider those turnovers technically. which have not been received, which have not been decided whether I would receive cash or I would receive check, because it's an outstanding debtor on a particular date. In speculative transactions, as we all know how it has to be calculated, guidance note says very clearly that it has to be taken on net basis. So if in case of derivatives and speculative transactions, if the net settlement is a loss or a profit, the ignoring the negative figure, loss and profit both has to be added for purpose of calculation of the turnover. Delivery based transactions, the total value of sales, if I'm a trader in the shares and if I'm entering into a delivery based transactions, I'm not an investor, I'm reporting as a business income, then the total sales value would be treated as my turnover for this purpose. So these are the basics. Again, I'm reminding, I thought I should remind of code of ethics and eligibility for tax audit. Please keep it in mind. If the tax auditor is applicable, I have been appointed a tax auditor under 44AB or 44AD or whatever clause. There are certain code of ethics and eligibility which we need to ensure. We need to communicate with our previous tax auditor, though there is no requirement to communicate with our statutory auditor. But it is always ideally better to communicate with them, because it's a communication between a professional to professional, and we can always get some insight if we are communicating with any other professional person. There are certain disqualifications under 288. Please keep it in mind while carrying out the tax audit. Selling limit in tax audit, institute has prescribed, as you all are aware. I'm just skipping, it's only for a matter of information. 3CD overview. I'll come to now specific issues only on certain clauses, which according to me, I feel certain issues needs to be addressed. If anybody will have any particular issues or questions, I'm sure they would be forwarded to the coordinator, and I'll try to take it up that at the end of this session. But I have compiled certain issues which according to me needs to be refreshed. Clause 16. Clause 16, these are certain clause which, by my experience, most of tax audit, in case of SMEs, MSMEs, there are no reporting bit this done in this particular clause. My mind goes to clause number 16 bracket B. Pro forma credits, drawbacks, refund of duty of customs or excise duty, or service tax or refund of sales tax or value added tax, where such credits, drawbacks or refunds are admitted as due by the authorities concerned. So you need to report over here that wherever the refunds have been admitted for under any particular law, or the drawbacks have been admitted and you have not credited to profit and loss account, those have to be reported. Let's take a scenario. I am an exporter. I export a particular goods on last week of March. So as soon as I do an export, the question arises that whether I am entitled to a drawback, a duty drawback, a DPB or whatever it is, and whether I should recognize that particular revenue or not. If I'm recognizing that particular revenue in accordance with AS9, then obviously there won't be any amount to be reported over here. But obviously, if it is not reported due to uncertainty of realization, and because of our accounting standards, you are not crediting such amounts to your profit and loss, you need to report over here. That's what is stated. Now the question is, when would be a drawback said to be admitted by the due as the authority concerned? If I am making an application, does it means it has been admitted? The first question. Number two, I made an application, but before I sign off the tax audit report or the balance sheet, it actually gets admitted and you also receive the refund or the amounts of the drawback. Then what happens? Whether I should recognize and credit it to profit and loss account B? According to me, though this amounts not credited to P&L being in this particular nature, if under a particular law that amount is said to be admitted as a due by the authorities concerned, you need to report under this clause. Just a minute. Yeah, sorry. Now the question arises, what if the assessee follows a cash system of accounting? This is relevant when the accrual system of accounting has been followed. that in the accrual system, because once it has been admitted, you would be accounting. So generally, there won't be any difference between the reporting in my financial statements, and once I'm reporting that amount on an accrual basis, there won't be any amounts which will be reported over here. But what happens in the cash basis? Because in the cash basis, you would account for those refunds only when you actually receive. So in those cases, if it is admitted and not credited, then whether you need to report. So in my case, even if because it's a cash basis and it cannot be taxed over here under the computation, still you will not report over you. So under the cash basis, it has been admitted, but the question is, the ultimate objective is to determine the total income for that particular year. So though it has been admitted as due and I'm following a cash basis of accounting, whether I should report here, in my view, it should not be reported. Clause 17, a very important clause. A lot of controversies keeps on coming. Daily there are updation on judgments, what is happening. It becomes very important for the auditors to understand this particular section, get updates on what's happening in the judicial background also. Clause 17 requires you, where any land or building or both is transferred during the previous year for a consideration less than the value accepted or assessed or accessible by any authority of a state government for the purchase purpose of stamp duty as per 43 CA or 50 C. Details of property, consideration received, and value added. So, in case your auditee has acquired any particular, has sold any particular asset during a particular financial year or your audit year, and the value adapted by the stamp authority is higher, then you need to report in this particular cases. Now, so it is if you read the wording, it is applicable to land or building or both. So applicable to all type of assets. It is applicable when you sell land or building or both is transferred. And in case the value, there is a difference between the stamp value and the transaction value. If the stamp value is high, you would be reporting here. Initially, before the 43 CA came to a statute, there was an argument by us that we were not reporting in those cases where the stock in trade is was there, like in case of builders or developers, because 50C was only applicable to capital asset, and that is basically to an investor and not to the people who were reporting those land building as a stock in trade. But after insertion of 43C, obviously you have to report in those particular cases also, where the land or building is transferred at the value less than the uh, if you see the words, it's a land or building. So this matter has been a lot of controversy that whether we should report where the rights have been sold, wherein the leasehold lands, a lot of, as you know, a lot of businesses are been operated from the leasehold lands. We have a plot of land in MIDCs, in the industrial development, SIDCO, GIDC, which are long-term lease, 33 years, 23 years. Then you may also sell rights in the land which are encumbered. It's purely a leasehold land, and you may so there are a lot of judgments on this, wherein if you transfer the leasehold rights in the land and building, then the section 50C is not applicable. So this would be applicable only if you transfer it in the land or building. It would not be applicable in case of transfer of leasehold rights per se. So there are judgments which I put it on the slide, which can be noted, and so it does not apply to leasehold rights. Please note a very important point which I would like to bring it over here. As a tax auditor, I am doing a business audit. I am auditing the books of accounts of the business. A situation may arise. I am a proprietary concern also at some place, and I may have certain personal assets also, which I have sold during the year. The question is whether I need to report under 50C or not, because I may not have an access to a personal record sometimes. Because to my mind, what you are auditing is you are auditing the business books of a particular associate. There's an audit of a business. I may not audit the personal books. He may have two different sets of books. One is personal books, one is his business books. I am restricting my audit to the business books, which do not report such transactions. But there are certain transactions which are forming part of the personal books, which are not under my audit. So whether I should report it. In my view, I would only report in respect of the transactions in this transactions recorded in the books of accounts which are audited. Personal books are not required to be audited because the tax audit under 44AB is in respect of the business entity, a business concern. I am not going to do a personal audit. So if there is some personal asset has been sold, I sell my residential flat, which does not appears anywhere in my business books. So I may not have an occasion to report that particular transaction. But quite often I have seen it that though the chapter 6A deductions are appearing in the personal books, the auditor, for the benefit of the client, reports in the tax audit report. So once I'm doing that, then I cannot argue, I cannot state it as an auditor that I didn't have an access to a personal books, and therefore the transaction which was appearing in the personal books was not reported. If you are reporting a certain transactions from the personal books, then obviously all the transactions which should form part in the 3C should be reported. But to my mind, according to me, you should not go into the personal books if you are not covering the personal books. If you have a common books of accounts, there are no two separate set of books for the personal investments, personal share tradings, personal assets, and business books are separate, and you are not required to, then we may not consider, we may not do an audit of those personal books and not report under this particular. Clause 18, particulars of depreciation allowable as per the act in respect of each block of assets. So you need to give a depreciation working. A lot of times a question arises. There are 2 or 3 points which I would like to point out in case of depreciation. In most of private limited companies, we have seen it that the motor vehicles are being brought in the name of the directors just to save the RTO tax. The question is whether the depreciation is allowable or not. If you strictly use section 32, it says that it should be used and used for the purpose of the business and owned by the assessee. The question is when the assets appears in the name of director, whether it can be said as it's owned by the assessee and therefore depreciation should be allowable. There is a judgment which I have reported that when it 32(1) talks of ownership means a beneficial ownership and not only the registered owner. So even if the registered owner is a director, but because the funds have been provided by the company and company becomes a beneficial owner, therefore they will be entitled to a depreciation. I think so. We are supposed to report under the Companies Act the fixed assets which are not held in the name of the company. So you may be putting a note on this. So by seeing that particular note, an assessing officer may come to know that this asset is not been owned by a company, then you have this particular judgments to your rescue, and thereafter there are plethora of judgments. So depreciation will be allowable irrespective it has been held in the registered name of a director. Whether the depreciation is available for the period for which the plant was not in use. The plant during the COVID situation, it's very important. That's why it's here. For the period of 6 months, 8 months, certain plants may have not been used only. So there is a relevant condition of a use under section 32. So how you dealt with it as an auditor. Of course, this year, the generally lockdown has come from only 22nd March. So whether if it is not used for a particular period, there is a section under Income Tax Act, section 38, which says if it is not used, if a particular asset is not used, then the proportionate depreciation should be reversed. So if it is not used for any particular kind of situation, whether you should reverse the proportionate depreciation. There are judgments, of course, I've given one of them, but the question is use is relevant only in which asset is purchased. The use concept of section 32 should be used only when it is purchased and not when, let's take an example. We had a lockdown from 22nd of March to 31st of March, and you acquired a particular asset which got delivered on, let's say a computer, got delivered on 23rd or 24th in your office premises 22nd, and he just kept it in the cabins, all 10 computers, and they were never opened before 31st March because of the lockdown. So it's in the year in which it was put to use. Considers. So the first year when I'm acquiring, I need to test it whether it was used in this particular year, then the depreciation will be allowed, but it will not. But if in this year I have been allowed and in the subsequent year, that is from April onwards, because of COVID I'm not using, then that use test need not be applied. So in short, use test has been applied only in the year of acquisition of asset and not hereafter, because hereafter every individual asset loses its identity and it becomes a part of that particular block, and the block continues to get a depreciation. Uh, Depreciation on intangible assets is now allowed. Of course, now there is a specific entry also at 25%. So all the softwares, goodwills, whatever you are not, there was a dispute, but now on intangible assets, depreciation has been allowed. We can include in our tax audit report, and we should include it. The question that, of course, these are certain types of intangible assets which I've listed: goodwill, skill and know-how, brand name, non-compete, marketing and commercial rights. But the question still remains in regard to software, whether the software would be treated as an intangible assets or not, or it should be allowed as a regular expenditure. Of course, I'm not gone into, because every software is a different. Like if it's an operating system, obviously it comes with an hardware, so it gets capitalized along with the computers, and you're getting a computer depreciation. But then there would be a certain software which you would be buying, and it gives you only a right for a particular year. Every year that license has been renewed. So according to me, that may not be capitalized. If it is capitalized under intangible assets, then only you get a depreciation. But if it is not capitalized, it can be claimed as a revenue expenditure. So you need to apply a tax as an auditor. You need to scrutinize those particular assets, not only from an intangible point of view. It becomes very important for an auditor to identify, look into those particular assets, whether it is a capital expenditure or a revenue expenditure. If it is a revenue expenditure, it should not be capitalized and claim depreciation. It should go debit to your P&L. You may claim an expenditure. But I've come across, you won't believe, there are two types, two treatments have been given by some very large corporates also. A particular asset may be capitalized under the Companies Act, but under the Income Tax Act, still those are being claimed as a revenue expenditure. Even a large software cases where the implementation of ERP is happening, and you are spending 50 lakhs or crore rupees, a capitalization is be done under the Companies Act in accordance with your accounting standards. But there are certain judgments, judicial precedents, which says, though you are implementing an ERP does not actually increase your revenue, your profit making, your turnover increasing capacity, and therefore those are revenue expenditure. So you need to be updated on all those things. Clause 19, amounts admissible under section 32 AC to 35E, amount debited to a P&L, amount admissible as per those provisions. Tax auditor is required. Of course, this amounts is only for a limited to a notified backward areas in certain areas, which are notified areas. So it does not apply to 80-90% of businesses. But I just thought I will pass a rebate, because it says a 32 AD permits an investment. It gives you a deduction in case of investment in new plant or machinery in certain notified areas. The condition for deduction is available in the year in which asset is installed. Now the question issue arises over here. What if asset is acquired during the year but the installed in subsequent year? The deduction will be allowed in which asset is installed. So asset should be acquired and installed. Just keep it in mind. Clause 20, very important clause according to me, missed by most of us. Any sum paid to an employee as a bonus or commission for services rendered, that such sum was otherwise payable to him as profits or dividend, and details of contribution received from employees for various funds. My concentration is on section 36(1)(2). As you all know, in private limited companies, where the directors and shareholders are all the close knit family, and generally nobody would like to pay the dividends. So generally the bonuses or commissions are being paid, higher bonus or higher commissions are being paid. Tax auditor is required to pay report under section 36(1)(2) if any such higher bonus or commission is paid, which otherwise would have been payable to such directors as dividend. So how do you look into it? Uh, I would invite your attention to a judgment of a special bench in case of Dalal Brocha stockbroking. What happened in those cases? Where the ratio held is as under. Word payable does not mean that dividend should be statutory or legally payable. So even if the dividend was not payable, but you have paid bonus or commission in lieu of dividend, would be reported under this. Payment of dividend is discretionary and not compulsory. No evidence to show that directors have rendered an extra service for payment of huge commissions. The assessee has intention to avoid payment of full taxes. So what happened is, in this particular case, there were 3 shareholders and 3 directors. So all these directors were never taking a dividend, but they were withdrawing the profits by declaring higher commissions at the year end based on the profits. So tribunal said, sorry, this is nothing but as a dividend, and therefore it would be disallowed under 36(1)(2). Obviously, this was planning was done to avoid the dividend tax, because dividend is a double tax. If you pay it as a commission, it gets allowed as an expenditure in your company's books, and though it is taxable in the hands of the individuals. So you need to be cautious. You need to ensure, see to it that there is no disproportionate bonus or commission is paid only to the director shareholders. As an auditor, you need to ensure whatever bonus or commission is being paid to directors, you need to benchmark with the other employees also. Whether the other employees are also getting similar bonus or commission, then obviously as an auditor, you can be satisfied that yes, this bonus or commission is paid across the board, and therefore it cannot be held in lieu of dividend because it is not to dividends or shareholder. It may come to a situation where you are paying a statutory bonus of 20% to an regular employees, but when it comes to directors who are also shareholders, you are paying a hefty bonus of 100%, 80%. So you may fall within the mischief of 36(1)(2). And as an auditor, you need to have a proper backup, proper reasoning that why this additional bonus has been paid to director shareholders, what was an extra services which was obtained from you. So it's a duty and cascade on the auditor also. Though this 36(1)(2) is not been used by much of the assessing officers also as of today, but as an auditor, it becomes our responsibility to ensure that the director shareholders are compensated by way of bonus or commissions also in lieu to the services which they have provided, and not disproportionate to services what they have been provided. Number one. Number two, we also need to see that whether the company is at all paying any particular dividend. A case may happen where the companies pay a regular dividend every year, 10%, 20%, they are paying dividends. But at the same time, the commission is paid only in a particular year because of an extraordinary performance. And obviously, you can make a proper documentation, you can have a management representation to that extent, take a proper note from the auditor, from the management, get it recorded in the board minutes, how it has been, why this was given, go into the reasoning, and all should form part of your documentation while reporting under 36(1)(2). Clause 21, subclause A. Details of amounts debited to profit and loss account been in nature of. So you need to, this is basically an information para wherein you have to report certain figures. According to me, whatever you are reporting in this does not means that those amounts will be disallowed. It's an information for the assessing officer. These are the nature of expenditures which have been debited. Generally, details of amount debited to P&L being in nature of capital expenditure will not arise, obviously, because as an auditor, you are also certifying financial statements. So it becomes your duty that if it is in nature of a capital expenditure, you may make a capitalization itself and do not debit it to the revenue and then report over here. So generally, you would synchronize it, your financial statements with your tax audit. So there may not be a reporting. Question is, I would just like to point out over here that is a club entrance fees and subscriptions. Now, amount debited, what if the expenditure are club expenses, whether disallowed under section 37? Expenditure incurred at clubs bin entrance fees and subscriptions. Expenditure incurred at clubs bin cost of club services and facilities used. So you need to report under the two heads. According to me, if these are being used for the purpose of, even for the, if it's a corporate membership, you have paid some interest fees, you have paid for some subscription for the business meetings. Generally, the corporate membership allows the directors to use the services of the club. So these expenses are not disallowable under 37. There are various judgments. I've just given one of this particular judgment, which says that the corporate membership amounts paid by the company for the corporate membership cannot be disallowed, should not be disallowed. So it's an allowable expenditure. So you may do a reporting over here but that does not mean that there will be any particular disallowance. You have to, if you see any penalties or fines paid under any particular law also has to be reported over here. The question arises, we do pay a lot of late fees under the GST nowadays. So whether the reporting will come under here. You are paying late fees under, we were paying under VAT also, I believe. Under GST, you are paying for every day. Under TDS, you are paying. But of course, under TDS, because it is in nature of tax, it would be disallowed. But what about the other expenses which late fees you have been paid? To my mind, this late fees will not be disallowed and therefore may not be reported in this particular clause. There's a one judgment which in case of penalty was paid by stockbroker to a stock exchange. So whether this would be disallowed, tribunal held that this cannot be disallowed. This will not be covered under the rigors of 37(1). It's a regular business expenditure. Late fees paid under the GST is not in nature of penalty or a fine, and therefore it will not be covered under this particular clause. It is a late fee. 21B is the amounts inadmissible under section 40A, where you were supposed to deduct TDS and you have not deducted TDS. You have to make a reporting under section 40A. And now you are already reporting under the tax audit another clauses where you have to give the details of the TDS amount to be deductible, amount deducted, amount paid, before due date, dates of payment, everything. Out of that, certain portion comes will definitely appear over here where the disallowance has to be reported if amount is inadmissible on account of non-deduction of TDS. Now the issue that arises over here, if assessing whether we need to report, you may report a non-deduction of TDS in the non-compliance of TDS clause. But in case there is, if we get a certificate from the recipient of the amount that I have paid a due taxes through their accountant, whether you need to report under this particular clause. If you read section 48 bracket 1A, read with 201, it says that a disallowance will happen if the assessee shall be treated, if assessee fails to deduct TDS, the expenses shall be disallowed and he shall be treated as assessee in default. So thus if assessee complies, assessee will be treated as in default if he does not complies with 2011 basically. What does 2011 says? That this the recipient of income has not shown as his income. If he has showed as his income, though I am not deducted at TDS, I may be paying an interest under the 201, but still a disallowance under section 40 bracket A will not happen. So as a tax auditor, there may be a list of TDS where TDS has not been deducted. But you may seek a explanation from the management, or you may seek a clarification from the management. If they wish not to be disallowed, that you may get a certificate from an accountant that the recipient of the, there's a specific form, those certificate, that the recipient of the income has already declared its income and paid due tax thereon, and therefore I am not assessee in default. And once I am not an assessee in default, there will be no disallowance under 40A1A. Amounts of deduction inadmissible in terms of section 14A. Expenditure, as everybody knows, 14A is in respect of expenditure incurred in relation to income not includable in total income. So if we are earning any particular exempt income and any expenses have been incurred in relation to earning expenditure incurred for the purpose of earning that exempt income, it should be disallowed. What are the requirements of this section? It's important to know that section requires satisfaction of AO must as to correctness of the claim of the assessee. No disallow for satisfaction of AO must as correctness of the claim of the assessee. Very important. Now 14A casts a responsibility under a subclause 1 that if the certain expenditure has been incurred, then the disallowance should be done. And if I am assessee is not identifying any particular expenditure, then under the subclause 2, assessing officer must be satisfied that certain expenditure has been incurred for earning an exempt income, and in which case he can follow the prescribed method which is prescribed under Rule 80. If you generally see, as a tax auditor, what we are doing is we are reporting, we are giving the details, we are doing a working under Rule 80, and we give those details in our tax audit. as a forming part of the annexure. The working under Rule 8D is there. The question arises that in case the management says and the auditor, after verification of the accounts, is satisfied that there is no expenditure incurred in relation to income not includable in total income, whether still I should give a 8D working. According to me, we should not. 8D technically applies to the assessing officer. It's not my duty to work out on a proportionate basis. We are giving it, of course, it prescribes the law, our institute also prescribes, let's give the working for the 8D, but by giving a working under 8D, it does not means that those expenditure is actually disallowable. Expenditure, if after verification of the accounts, there is no expenditure incurred for earning those expenses, then there cannot be any disallowance under 14A, and therefore there cannot be any reporting under 14A. Auditor has to certify that whether any expenditure has to be disallowed rather than just giving a working, according to me. Now there are various judicial precedents which have come, which we should note while reporting under this particular clause. That if there is an interest expenditure, if I have a exempt income and I have own funds also and I have a borrowed funds also, and out of those common pool funds, I've used those funds for earning an exempt income. How to do a proportionate basis, whether you allow? So there are judgments which gives the benefit to the assessee that the natural the DB provide it would be presumed, there is a presumption drawn that if I have both the funds and there are sufficient interest-free funds, then always there would be a presumption that the interest-free funds have been used for earning the exempt income, whereas other funds have been used for the purpose of the business, which are the borrowed funds, and therefore there cannot be any discounts. If I'm receiving interest, I'm paying also interest. And if you're giving a working under Rule 8D, in my view, you should consider the net interest position only for the Rule 8D. So if I have an income receipt also and I have an income payments also, what is my net interest income can be considered for the purpose of Rule 8D. For applying a Rule 8D, if you are giving an 8D working, question arises is there are certain investments from which no income has been earned during the year. Those investment may realize an exempt income if at all in the future years, but in this year there is no exempt income earned, whether while applying that 1% formula in the average working of the investment, whether I should consider those investments. In my view, they should not be considered because there is no exempt income earned during the year. So only those investments should be considered where any exempt income has been earned by you. No disallowance can be made if no exempt income earned. Disallowance cannot exceed exempt income of the year. So if there is no exempt income during the year, then 14A is not applicable according to us, because there are various judgments again that if the exempt income, there's no dividend income, there's no of course now all this will go after 1st April 21 once the dividend become taxable. Hardly any exempt income will remain and 14A will lose its value also. But up till March 20, this remains today because dividend was still exempt in a lot of cases. And is referred to in section 43B. 43B says that certain payments of taxes, interest, certain amounts payable to scheduled banks, PF, ESIC would be allowed only on actual payment and not on actual basis, or in case those payments have been within the due date prescribed after the year end also, it would be allowed. So in this particular case, the question issue that arises is on 31st March, there is some excess payments of GST lying in electronic cash ledger. Whether I can claim this as an expenditure under section 43B. So I have, though it will appear as deposit in my books of accounts, it would be appearing as a credit in my books of accounts. Whether I can claim that expenditure under 43B because it is on the payment basis. I made a payment in the electronic cash ledger, that money belongs to me. I can claim a refund also out of that. Still, I can claim or not. Now, the similar issue arose at the time when there was in case of Modipon Limited, where there was an unutilized balance in Senvet credit, and that was written off. So the said balance, there's no hope of recovery of the above amount. But I had already paid it because Senvet credit. What does Senvet credit contains? Senvet credit contains basically the amounts paid by me to the buyer of the to the supplier. So it's as good as paid. Similarly, what I'm paying in the cash ledger or in the PL is as good as paid. So in today's time also, in the GST time also, there may be the balance lying in electronic credit ledger, and I may not be able to utilize those balance in electronic credit ledger for 5 years, 10 years possibly, where the margins of value additions are not high, or the opening GST trans credit was quite high. So what happens to that? Whether those amounts can be claimed? So my amounts are blocked in at one place. Already 100 rupees are blocked in standard credit or in a cash ledger, and I'm also paying 30% tax on that because I'm not getting the deduction of that payments. To my mind, electronic cash ledger will not be available. But in case of the balance available in the electronic credit ledger, that can be written off and can be claimed under the section 43B also. So there are two ways that if you write it off, and because there is no certainty of adjustment, you will be allowed as a deduction as a P&L. And if there is an argument that this cannot be allowed because there's no it's a 43B will attract, then it is as good as a paid to the supplier, and therefore also it should be allowed under 43B, for which Modipon Limited will help you. Clause 29, very important. 5627B casts big responsibility on the auditors, where clause 29 is regard where during the previous year assessee received any consideration for each shares which exceeds the market value of the shares as referred to in 5627B. Yes or no? Yes. This is applicable basically to closely held companies. It is not applicable to companies which are public companies, which are listed, which are subsidiary of listed companies. There is a certain exclusion, but generally it is applicable to private companies. It also gives an exemption. What does the auditor requires over here? First of all, auditor is required if there is during the year any company has issued a share at the value which exceeds the fair market value of the shares as referred to in 56 2B, you need to report. So it's a case of a share premium basically. So your shares fair market value is say 15 rupees, and you have issued at 30 rupees. Then the 15 rupees has to be reported under 5627B. That's what the requirement of this particular clause is. So how do you determine what's the fair market value for the auditor? First of all, you will need to determine is whether it is applicable to my company or not. If it is a closely held, it is applicable. Then there are certain exemptions available to you, that if the investor is a non-resident investor, the person who is subscribing to the shares is a non-resident, it's not applicable. If the investing company, that is auditing company in your case, is a VC venture capital, then it is not applicable. If the investing company is a startup company, it is not applicable. So leaving apart this exemptions, generally to all particular entities, 5627B is applicable. As an auditor, it is your responsibility. You will have to tell your management if they we have seen it that lots of people do not obtain the valuation report, and the valuation report is not obtained, which is not in accordance with rule 11U and 11UA. As an auditor, if there is any issue of particular shares, it becomes your duty, or if that particular company is holding such investments in any other private limited company, your auditing company is holding any shares of private limited company, and they have been transferred during the particular year, which is covered under 56 to 10 in next slide. Then as an auditor, you will have to insist for a valuation report, that please provide me the valuation report, because only on the basis of that particular valuation report, you can determine what is the fair market value. Once you determine the fair market value, you compare with the issue price, and that difference has to be reported under 5627B. It is important to know at this stage that if the valuation report is issued by the merchant banker, whether an assessing officer, from the perspective of the income tax act, whether the assessing officer can disregard it. According to me, assessing officer cannot. He cannot challenge the valuation report because he is not an expert on valuation. But in the practical world, they are challenging. They are rejecting the valuation report for the various reasons, because if for reasons such as that the projections taken while calculating a discounted cash flow has not been achieved, because he is sitting after 2 years to do an assessment, and then he compares those projections with actuals and come to a conclusion it has not been achieved, and therefore the projections were not appropriate, and therefore I rejected. But legally they cannot reject it. So as an auditor, we need to ensure that the valuation report has been issued by the person who is authorized under the Income Tax Act, like a merchant bank. And we need to take a report on the record. And unless and until there is a glaring error in those, like there is a whole lot of standard on us that how you should rely upon the third party certificate. This is as good as third party certificate. So unless and until there is a glaring error which we may brought it to the notice of the management that I cannot accept that valuation report. If the valuation report is properly drawn in accordance with the standards, we may accept the third party certification and report a fair market value. And if there is a difference, then we report under 56(7)(b). There's another clause, very important clause, 56(9). Advances received in negotiation of transfer of capital asset, if forfeited, needs to be reported in this clause. Again, an issue comes over here. How do I verify if I am an auditor of a proprietary concern who is maintaining two sets of books for the personal assets and two sets of and for the business assets? I may not be able to verify. So I will restrict my verification to the auditor books of accounts which are produced for the audit of a business entities. In case of business entities where any immovable, any capital asset is proposed to be sold and you receive some advances, if those advances are being forfeited, needs to be reported in this particular clause. Only if the forfeiture is done. If the advance remains outstanding in the particular balance sheet, then you need not report under 56(9). So I received an advance, and this advance is lying in your books since maybe 2 years or 3 years, but still because of forfeiture has not been done by the assessee, you need not report in this particular clause. If the forfeiture entry has been passed, you pass the entry by knocking off this advance to an income, you will do this. Question is whether this applies to an asset which is a stock in trade asset, like a developer. Developer may be may have and those immovable properties or assets. Will it apply? Because they classify those assets as a stock in trade. According to me, it does not, because it applies only to a capital asset. So assessee which classifies those as a capital assets, it will apply to all those capital assets. Reporting requirement. If it is in respect of personal capital asset, where neither asset nor advance nor forfeiture is recorded in the books of accounts of business, as I mentioned. However, if personal capital assets are recorded in books of accounts of business, then on forfeiture reporting is required. Mere notice of forfeiture may not amount to a forfeiture. If no amount is written back by the assessee, reporting is not required. Thus, only on reporting on written back of this asset, he may write off it to directly to the reserves. He may write off it to the capital, may not take it in from to the P&L. In which cases you will have to report it over here. Question arises that there is a contract. It says that if the amounts, if the transaction is not completed within the 6 months, the amount will stand forfeited. Whether in such cases we need to do a reporting. According to me, even if there is a right to forfeit, whether we need to do it. What if assessee forfeited amount without right, then there is no action, but such amount will become the income of the assessee. We need to report. So if the forfeiture happens, though there may be a right to forfeiture, but the forfeiture has not happened, you will not report. You don't have a right to forfeit, but the assessee has forfeited, then you will report it. So the reporting is purely on forfeiture basis. 56 to 10, again, similar to 56 to 7B, which applies to shares. You need to report if any sum of money is received above 50,000, the gifts which are not coming under the exempted category, properties other than the immovable properties. In case of immovable property, if you're buying any particular asset and the value of the asset is you have bought at the price less than the stamp duty value and the difference is more than 5%, that is 105% of the transaction value, then you need to report. If it is within the 105%, you need not report it. In this case also, you may have to determine the fair market value of immovable property. So auditor will have to insist for the fair market value to be determined as per the valuation report. You can do it, and that can be compared with the stamp duty value. Shares and securities, same as we have discussed, will apply similar to 11U and 11UA. I'll just keep that. Clause 30A, I will whether primary adjustment to transfer price is referred to in subsection 92. This is very specific to a transfer pricing assessment, where if any adjustment is made in transfer pricing, whether there is a transaction between assessee and the associated international enterprises, and you have where the transaction is not at arm's length, and you have suggested some primary adjustments, that instead of 1 crore sale value, your sale value should be 2 crores. So you have charged 1 crore rupees. Then this 1 crore rupees will be treated as receivable from an international associated enterprises. And what does this second adjustment requires us? That in case the primary adjustment is more than 1 crore, then the interest has to be also calculated on that notional 1 crore receivable and be reported under 92 CE. So it's a very specific to this. There's a new clause again, section 94B1. Of course, this is again applicable to company wherein you are paying an interest to a non-resident associated enterprise. Non-resident associate, where assessee pays interest to a non-resident associate enterprise in excess of 1 crore, the interest allowance has been restricted. So if you are paying if you have taken a loan from a non-resident associated enterprise and the interest payment is more than 1 crores, then there is a restriction of allowance, the total interest paid, or 30% of your EBITDA. So your auditor will have to calculate the EBITDA and 30% of it. And if the interest paid is more than in excess of 1 crore, and it is more than 30% of EBITDA, you need to report over here that what is 30% of EBITDA, what is interest, because any expenditure of interest above 30% of EBITDA will be disallowed, subject to being in excess of 1 crore. Clause 269 ST is in respect of 2 lakhs rupees or more, any transactions, if you receive in cash, I would say otherwise than by account paid check, account paid backdraft, electronic clearing system through a bank account, you need to report. If you receive more than 2 lakhs in aggregate from a person in a day, in respect of single transactions, in respect of transactions related to one particular event, you need to verify, go through a day book, go through a ledger, because for a particular bill, the amounts would be received in an installments. You may receive it, but if it is in respect of a single transactions, if a transaction is of 2,50,000 and you are receiving 25,000 cash in 8 installments, because it is in respect of a particular single transaction, you will have to report under this. Deemed dividend, I'll try to jump because this is also very important. It's a big issue. We'll just see what the legal provision is there, which will help in reporting in the audit. Deemed dividend arises when applicable in case where advance or loan by a company to a shareholder, where the shareholder is holding more than 10% of the voting power, or advance or loan by a company to a concern where such shareholder has a substantial interest, that is more than 20%, and payment on behalf of individual benefits. So 222E deems a particular certain transactions as a deemed dividend, wherein the amounts are given as a loan to a shareholder. Those are falls under the deemed dividend. So where the shareholder to a shareholder which holds more than 10% of the voting power, or if the loan is given between two corporate entities from one X to Y, or to firm where the shareholders own more than 20%, the shareholder of my company, the assessee company, owns more than 20% of that particular stake in that another company, then it will fall within the clutches of 222E. You need to report those particular transactions. 36A. The deemed dividend needs is taxable only to the extent of accumulated profit. So technically, if you do not have an accumulated profit or there is a losses, it is not applicable to you. So the reporting may not arise. If there is actually dividend where where the amount of loans or such advances are within the accumulated profits, you may need to report in this particular clause. There are a lot of difficulties how to find out accumulated profits of the peer company, position of accumulated profits. Let's take an example. Already accumulated profits are there, but there is already deemed dividend been taxed in previous year. So you may have to reduce notionally from those accumulated profits amounts already reported in previous year. So if you have given a 10 lakhs advance today, in this year, 10 lakhs advance is the next year, and accumulated profit is 15 lakhs. So 10 lakhs which has been reported last year will have to be notionally reduced from the accumulated profits. So your accumulated profits will come down from 15 minus 10, 5. And if further 10 lakhs advance has been given, the deemed dividend would be only treated to the extent of accumulated profits, that is 5 lakhs. So you need to obtain a certificate from the assessee. How do you ascertain how many closely held companies are there? What is the shareholding pattern of those companies? Whether because I am an auditor only of the assessee company, I may not know my individual shareholders may have an investments in many more companies with whom the company assessee company does the transaction. So you need to obtain a certificate from the assessee containing list of closely held companies. Particulars of advances received by concerned assessor is substantially interested. Based on that, you will get the list of those parties. Then you need to verify those transactions, test it to 232, and then report under this particular clause. There are various issues under this deemed dividend. Who is to be taxed? So there can be a registered. Yeah, my voice was less. It's again come, I think so. Who is to be taxed, whether a registered shareholder or a beneficial shareholder. HUF, shares may be held in the name of Karta, but the beneficial shareholder is the HUF. So the question arises in whose case it would be taxed. Although HUF is a benefit but cannot be a registered share certificate issued in name of Karta. Therefore, it shall consider deemed dividend in the hands of HUFs. So Supreme Court has been held that it would be taxable in the hands of the beneficial shareholder. So this becomes very important and need to be verified when there is a transaction between a corporate to corporate. Because in the corporate cases or corporate to a partnership firm where a partner would be representing as a shareholder. This is how do you do it if there is a common shareholder between two companies, company A and company B. There is a loan given by company A to company B, and there are three common shareholders or two common shareholders. How do you actually tax it in the hands of the individual shareholders? According to me, it should be on the proportionate basis. But technically, after tax on distribution company, now this goes down. There's a DDT. But again, this issue may arise because the responsibility now has been put on the company. So as an assessor, you need to see that if it is a deemed dividend, this tax has to be paid by the company. There are judgments of this Mumbai Tribunal, which is intercorporate deposits which are permitted under the Companies Act will not be subject to 22E. You may please make a note and be considered while reporting under this audit. So they may not. Advances made in ordinary course of business cannot be treated as loans and advances. In nature of current account, where there is a current account on happening, so sometimes the directors make the payment on behalf of the company and gets a reimbursement. So such transactions will also not fall within the rigors of 222E. So thank you very much. I've tried to finish it. This, if any questions are there, I can take it now. Thank you very much. Thank you once again for your patience hearing. Thank you.
Thank you, Piyush bhai. Really excellent session, and you have covered various issues which are really what we are facing while doing tax audit. So I request Piyush bhai, if you can stop your screen sharing. Mishra ji, now can you post the questions?
Yes.
Piyush bhai, can you read that question or you want me to read?
I can't read it. Where is it coming? Chat box.
No, it is coming on the screen.
I've stopped this.
No, the WRC has now started sharing the screen. So on that, it is visible to you, Piyush bhai, or I read? The question number one
read it. I think so. It's not visible to me.
Yeah. The due date of furnishing of TAR for financial year 1920 is 31st October, whereas the return filing due date is 30th November.
I can read it, Manish bhai. Manish bhai, I can read it.
Okay,
now.
Okay, sir.
So according to me, though the tax auditor may furnish that it has not been made the payments up to, so he will give the due date. He may report under the 43B. But if the payments have been made before filing of the return, please claim it in your computation of income. It is an allowable expenditure if it has been paid before due date of filing the return. So you can claim it in your computation, irrespective reporting done by the tax auditor. I'll take up the question one by one. Question number 2. The loss and depreciation referred to in clause 2 and clause 3 of subsection 2 shall be deemed to have been given full effect to and no further deduction for such loss or depreciation shall be allowed for any subsequent year, provided where there is a depreciation allowance in respect of block of assets which has not been given full effect to prior to assessment year beginning 1st April 20. Corresponding adjustment shall be made to WDS as on further in the prescribed. If the option under subsection 5 section to assessment year beginning on, I don't know what the question is. Yes, it would be done. What's the problem is? It should be deemed to have been given fully, but over the last provided that. Yes, that's correct. That's correct. It has to be done in this particular manner. Question number 3. If there are different views on any provision, then will ICAI come with any guidelines on those provisions? See, I see this as a guidance, which are the generally where we do revision of guidance. So that in the income tax act, there are a lot of disputed views, whereas it was very difficult for institute also to give a guidance or decide on a particular basis. Let's take an example. There is a written, if there is some amendment which is happening, and there are two views possible even at the level, and they may not be accepted by judiciary. I may have a different view, Manoj Pandit may have a different view. So question is, how would an institute do that? So generally institute, when it makes a guidance note, it would not actually say what would be the decide. It would only give you what audit steps you have to take. And if there is a difference of opinion when we are revising the guidance note, generally we will tell you to do a reporting, that's all, and leave it without giving any your opinion thereon. So if there is a different views on any provisions, generally they will not be able to give a confirmed view, even an ICAI to my view. They will not be able to tell it has to be done in a particular manner. They cannot do an interpretation of how 5% receipt or 5% payment will be considered or held by judicials or by the income tax authorities. So there can be views which may not form. For a stockbroker, whether a commission can be considered as a gross receipts and can be covered under presumption income, please clarify. According to me, no, commissions are outside the 44AD presumptive tax if you have only a commission income. Question number 5. Sir, when VAT department has raised a demand and assessee has paid it and kept as a deposit with in books of, and after assessee when the refund has been granted, do we need to report the same under clause 16? Whether this is an income, of course, the interest on refund is taxable. Similarly, if assessee received GST refund on zero dated supply, whether this should be reported under clause 16, whether this would form part of income taxable. Question is, if it is an income taxable, obviously you will be crediting to a profit and loss account. What you are reporting under clause 16 is amounts which have not been credited to profit and loss account. Let's take an example. When the deposit has been made in the first case where the VAT department, there was a demand and you have treated a deposit in your books of accounts. If you have not claimed any benefit under the lax law, obviously you will not report it when you receive a refund also, because it will go in knocking off your deposit amount. You will not report it. But there may be a situation, if you have recollect my 43B slide, any amount deposited as a part payment in the VAT was allowable as an under 43B. So you were not debiting the profit and loss account, but under 43B, you could have still claimed as an expenses. Now, if you have claimed a 43B expenses, obviously you have claimed, and whenever the refund is received, it becomes a taxable. But in the books of accounts, you are reducing a deposit, in which case you will have to report. So if you have claimed expenditure earlier year, then obviously this is taxable in the year, and because you are crediting to a deposit and not credited to P&L, you will have to report over here. Is there any question below 5? Manish bhai, niche jana.
No, I think so. इतना ही है. So, yeah. Thank you, Piyush bhai. Really an excellent session. Piyush bhai, I also have one query which I am receiving from various members. You know that I am not into tax audit. So, if suppose somebody has filed his tax audit report on 6th October or maybe on 15th October, so whether now he has to again refile the tax audit report under the new schema which came this week only? What is the view?
No, according to me, no. According to me, no. If the tax audit is filed, you need not resubmit it.
So before
I don't know if yesterday's instruction has mentioned anything, but what is filed is filed.
Okay.
If yesterday's instruction, I don't know, 700 pages instruction have come. I don't think so there would be such provision, though I have not gone through that. But initially also, whenever the schema was been revised and the report was already filed, you need not file a fresh report, because as a tax auditor, I cannot issue a revision. It amounts to revision of my audit report, which I cannot do unless and until there are circumstances which allows me, permits me to do a revision of tax audit.
Okay. Thank you very much, Piyush bhai. Now I request my coordinator, CA Malvika Mitra, to propose a well-deserved vote of thanks to Piyush Chhajed sir. Over to you, Malvika madam.
सर वो ऑफलाइन आ रही है.
Okay. Yeah, she.
Got it. Yes, so thank you very much, CA Piyush ji. First of all, let me on behalf of WRC, on all the members, and personally, let me thank you for enriching us with all with your experiences and with all your clarification on various sections and rules. And especially, I would like to thank us for giving us assurance for the extended due date. Thank you very much, sir. That was most needed for all of us. Manish is giving a very soft smile because he's not into tax audit, but we know what the pressure is right now with us. So thank you very much for giving this assurance. Hanji, sir.
Thank you, Malvika madam. And whatever Piyush bhai has said as far as the due dates are concerned, that is his personal views. So
that is why I said that he's just giving us assurance, and we are very happy and confident now.
Yeah.
Thank you so much.
So now we have another speaker with us, CA Manoj, CA Advocate Manoj Pandit, and a good friend of mine. And he is definitely going to guide us the new amendment in the tax audit report. As I already said in the beginning, that always we are seeing every year some or the other changes are there in the tax audit, and we need to understand and deliberate that in great detail. So definitely Manoj sir is going to discuss and guide us on the new amendment. But before inviting him, I request my colleague Malvika Mitra to kindly introduce CA Advocate Manoj Pandit. Over to you, Malvika madam.
Thank you so much. Thank you so much, Manish ji. And it's my privilege to introduce CA Manoj Pandit. Though he has been introduced as a lawyer, his main profession is dealing with law and everything, but he is a chartered accountant like all of us. He's a company secretary, of course, bachelor in law, definitely. And he's been holding diploma with the Institute of Chartered Accountant for Information System Audit, and also a certificate course with Institute for arbitration, mediation, and counseling. And very special is he's holding a diploma in therapeutic counseling from College of Social Work, Nirmala Niketan. Professional career, I would say Manoj has started as an associate with various CA firms from 1996 to 2007 in various capacity, including as a chartered accountant in the field of taxation and different organizations, including Prime Builders, India Bulls, real estate, and many more. But he has joined the law professions since 2015. Now, special in-depth, I would say, expertises for last 24 years of his career. Manoj has been associated with various professional firms and business organizations, which helped him enrich his knowledge in the field of direct and indirect taxes, corporate and especially the commercial law, international taxation, corporate structuring, auditing, and project funding. In addition to that, he has represented to various government agencies, the finance ministry, CBDT, CPEC, and various direct and indirect taxes issues independently and also on behalf of the clients and organizations, which includes Federation of Indian Chambers of Commerce and Industry of FICCI. He also has been, we all know is a very famous faculty with the Institute of Chartered Accountants, always there with us, guiding us throughout. with various matters relating to tax laws, immovable properties, international taxation. Today, we will be having him specially for the changes in the indirect taxes. In addition to that, his areas of practice for everybody's interest, I think, includes representing clients at all the various government authorities and mostly on all the direct and indirect taxes. His profile is so very much in detail and so much lengthy that I would take 2 hours to complete that. So over to Manoj ji. हाँ आप ही थोड़ा सा ब्रीफ में बता दें सारा कुछ. Thank you so much.
Thank you Malvika ji. Thank you Manish ji, and thank you Piyush bhai. I have very close connection with Chhajed and Joshi CA firm, because I was article student of Jain and Jain Chartered Accountants, and C&AG, whenever allotted the audit work, first the entity was already audited by Chhajed and Joshi, and then it come to Jain and Jain. So at least 3 or 4 audits which were already done by Chhajed and Joshi, thereafter was done by Jain and Jain while I was article student. So I feel as if I know the firm as it is. And again, today also my turn is after Chhajed and Joshi. So continuing my articleship experience. One thing about the tax audit, Manish bhai, you asked that what will happen if the tax audit report was filed on 6th of October, whether that will be valid or not valid. So my view is different here, that tax audit report filed on 6th of October is invalid, because there is a notification number 33 of 2014 which says that if there is any change in schema or form is to be updated, then the chartered accountant should not file return and wait for the new schema to become. In this particular case, the notification was there on 1st of October that there is new form is coming and new schema is coming. And because of notification number 33 of 2014, chartered accountants should wait, and it is forced upon them to wait. By law, they are supposed to wait. And therefore, we are very much positive that extension will be there. So to add to Malvika ji's concern that whether date will be extended or not, yes, date has to be extended, because chartered accountants were forced to wait because of circular notification number 33 of 2014. There are already various writ petitions been filed by various tax practitioner association and bar council, and we are waiting in Gujarat, in Rajasthan, in Bombay. And one more thing which I want to point out about what Piyush bhai has said about section 11U, 11UA and section 15CA, section 56, those amendments. There is already a writ petition lodging number 3575 of 2020, which was heard yesterday, day before yesterday, in Bombay High Court, and Bombay High Court has already issued notices about constitutional validity of these provisions. So now these deeming provisions, whether they will be applicable or not, whether they are constitutionally valid or not, is under challenge. And as a tax practitioners, we should keep updated of this knowledge, because this is going to change the way we are going to report things. And typically, as you rightly said, Malvika ji, that at heart, I am a chartered accountant. So even in courts, I do vouching of brief, I do auditing of FIRs, and instead of written opinion, I give my arguments to court. And luckily, I have survived very well on my articleship experience. So no further experience was required to start my practice. And this has happened not only in taxation laws, but also in criminal courts when I am applying for bails, in civil matters, in writ petitions, original side, appellate side, everywhere it has helped. The way we have been trained to minutely scrutinize document and form an opinion. See, what happens is that if you are good on facts, law anybody can read a day before and start practicing law. If you are good on fact, if you know how to give your opinion, then yes, you are already practicing law as a chartered accountant. So now coming to our presentation of recent amendments, rather Piyush bhai has already covered most of the areas, and there is hardly any work to be done by me in that direction. My focus area always remains on answering members' queries so that they are not left out and they take something home when they attend a seminar. To start with, I will say that if any one of you are having any queries, you start posting it right now, so that we will answer those questions in due course as and when we progress further. My screen is visible now?
हाँ सर दिख रहा है.
दिख रहा है ना? So we are covering the amendments. So most of the things has already been covered. Hardly any job left for me to do. Applicability of section 44AB. These are the situations we have already discussed. This business turnover rupees is greater than 1 crore, or professional gross receipts is more than 50 lakhs. Presumptive profit is greater than actual profit. That is, actual profit is lesser than presumptive profit, and you are following presumptive taxation. Section 44A, 44BB, 44BBA, and 44ADA. And section 44AD subclause 4 is applicable, along with the condition that the maximum amount not chargeable to tax is lesser than your profits. So if your total amount is not taxable, then obviously a tax audit is not applicable. We were discussing in previous session whether tax liability, GST, is to be included for the purpose of gross turnover or not. And there is a gray area, because of a simple reason that all this section of presumptive taxation says that you are not supposed to maintain books of accounts. At the same time, you have to prove your turnover, because whether you are fitting in those limits or not. And typically the question of inclusion or exclusion of GST or other taxes will come when you are on a borderline, that your turnover without GST is less than 1 crore and including GST is more than 1 crore. And typically in a situation where you are not supposed to maintain books of accounts, because the moment you say you are maintaining books of accounts, then obviously you will be having your book profit also, and you may have to disclose that also. So what one should take as a stand, and on a safer side, since we are all chartered accountants, why we should reduce our work. Whenever in doubt, tax audit is applicable. So a practical stand is, if your turnover is less than 1 crore, excluding GST, including GST it is above 1 crore or whatever threshold limit we have, then tax audit is applicable. There is no penalty for doing tax audit when tax audit is not applicable. In a borderline situation, it is always better to take a stand that tax audit is applicable. Now, second issue is, there is an extended limit of 5 crore rupees for businessmen if they are doing their business entirely through banking channel. And as a liberty, if their total cash receipts is less than or equal to 5% of total receipts, and total payment is less than or equal to 5% of total payments. So though I want to take a view which Piyush Bhai has taken, that this 5% scenario is applicable only to business expenses. However, when you say total receipts, I tend to take a view that total receipts means total receipt, business receipts, whether they are for capital account or revenue account is immaterial. So even if you have introduced cash in capital account, that will be considered as cash receipts for the purpose of this section. And if you have done drawings in cash, then that will be considered as total payments in cash. Even if you have paid taxes in cash, in my humble view, the amount which has been paid in cash will include the amount of taxes which has been paid. 44 AB, we are all chartered accountants. We have already gone through this, and I will just keep these things. As I said, even taxes paid in cash will have to be covered. This is a broad scenario where 44 AD or presumptive taxation comes into play, where turnover is greater than 5 crores, profit percentage is immaterial, cash payment or received above or less 5% is immaterial, tax audit is squarely applicable. Between 2 crore to 5 crore, if cash payments and receipt is less than 5%, then tax audit is not applicable. So we get benefit of spending more or earning more in through banking channels. Reverse situation, if your cash payment receipts is greater than 5%, tax audit is applicable. And this presumptive taxation, interesting to note is that the turnover limit of 2 crores is applicable to businesses. And if you are doing through banking channels, then your presumptive taxation is at a lesser rate of 6%. The similar situation for professionals, section 44 ADA, only difference is here you will have to offer 50% of your gross receipts as taxable income, otherwise tax audit will be applicable. Tax audit is applicable only provided your income exceeds the basic exemption limit. Otherwise, tax audit is not applicable. (44) is tax audit report is to be signed by a chartered accountant, though Act says it's an accountant. Accountant has been defined, and on various forums, it has been argued that every time, whenever there is change of forms or pressure is there, it is chartered accountants who go and ask for extensions. And it has come as a bad reputation to us that we are not able to perform our work in given space. And even courts has noted that per se the chartered accountants do not have a locus standi because it is responsibility of the assessee to get his books of accounts audited. And therefore, we have to plan our activities in such a way that at least we are not the one who are asking for date of extension, and it is assessees or maybe their trade unions who are going into various forums for representation. As a member of professional body, we understand their concerns, and the way patient doesn't understand his problems, only doctor understands it. A similar way, as a chartered accountant professional, knowing their problem, we can always send a representation through our institute, and which we have already done. And as everybody is expecting, I am also hopeful that when the due date for filing return has been extended, why there should be a restriction on filing of tax audit report. Considering the COVID situation and considering the fact that even the full-fledged working of courts and local trains and all other infrastructure is not there, we are hopeful that we will get the extension which we are looking out for. In case the assessee is liable for tax audit and he fails to conduct audit, then there is a penalty which is 0.5% of turnover or gross receipt, or rupees 1,50,000, whichever is lower. A practical solution sometimes is that you can file a tax audit report without filing income tax return, and that you are unable to form an opinion is an opinion. So a very practical stand that yes, due to COVID situation, the books of accounts could not be verified by us, and therefore we are unable to comment or complete the 3CD report is a good tax audit report compliance. And definitely, if this date is not extended and somebody takes this stand that due to this COVID situation, due to non-working of the office premises of chartered accountants as well as the business, we are unable to form an opinion, or we could not conduct an opinion tax audit, is a good tax audit report. And there is a bright chance that looking at the way judiciary has been looking at COVID situation, you may be waived off of the penalty if at all it is levied upon you. But as I said, this is a last resort. If nothing else happen, no opinion is a good opinion. It's an opinion. These revised tax audit limits are applicable to all entities. Now the form 3CD and 3CB filed before 1/10/2020 are valid. The ones which are filed between 1/10/2020 till 22/10/2020 are prima facie invalid, as I said, because of the circular notification number 33 of 2014. Since Piyush Bhai has already covered most of the part, I would like to deal with the aspect that how you read and what happens when you report something. So I will just take you through form 3CB, where the details of businesses of the assessee are to be filled up. So you write the name of the entity, you write their PAN number, and you write the assessment year for which you are doing the audit. Thereafter, you write the address of the assessee and number of branches it has. Now, how this information affects your own reporting and the way income tax department deals with this information. You have given the registered office address and number of branches. Therefore, the income tax officer gets a right to do a survey on these premises. The income tax department cannot come at assessee's residence, but it can come only on office premises or business premises. The business premises has been reported in your form 3CA, 3CB and 3CD, and therefore on those premises surveys can be conducted. Secondly, the same information is utilized to find out whether any expenditure is incurred wholly and exclusively for the purpose of business. So your telephone at residence, whether it has gone into your telephone expenses, and whether that residence address is one of the business addresses. This needs to be verified, because otherwise not reporting of personal expenses debited to profit and loss account will be held against you alone. Thirdly, considering the way the GST and customs department and income tax department are sharing data with each other, if you are paying rental of any premises on which GST is being charged and you are taking input tax credit, whether that premises has been reported to income tax authorities also as a business premises, because when these informations will be combined and there is lapse, there are consequences, there are penalties, there are prosecutions. And therefore, it is utmost important that don't take it casually. Just because we have been filing it for last 20 years, it will have no impact. I have seen that the address, registered office address, which is mentioned in 3CA, 3CB, is actually not the office address as per income tax profile of the assessee. And we have not updated the form 49A to get those changes amended in the database of income tax department. Quite possible that because of change of address, there will be migration of the entity from one assessing officer to another assessing officer. Quite a possible that city might have changed, and you have to take care of these things because it have a long lasting repercussions when we go and file our assessments or appeals, or at the time of search, survey and raids. Now there are some changes made in Form 3CD. One starts at clause number 8, serial number 8 rather. There is a special scheme in which income tax department has given a reduced tax rate applicable to certain domestic companies engaged in manufacturing and allied services, which has been specified, and there are conditions that they are not allowed to take any deduction, benefit of depreciation, benefit of carry forward losses, business depreciation allowances, and they are not allowed to or entitled to take any deduction under chapter 6A except two sections, that is ATM and ATJJB, and that we have to report at section serial number 8. Apart from that, there is 3 forms which has been specified, which has to be filed online, and the choice of the assessee to exercise those options has to be intimated in advance. So as a chartered accountant, we have to ensure, as a tax auditor, we have to ensure when we report under clause 8 whether that forms 80IA, 80IB, 80IC, 10IA, 10IB, 10IC has been properly filled or not, and we should keep it in our audit working papers so that there is no misreporting of transactions. On 22nd October 2020, when the schema was declared or released by the Income Tax Department, they have added 115BA at clause in a drop-down list. So just for your benefit, you have to just select one of the two. There are these rules which has come into place because of changes in sections and the benefit which is going to accrue or arise because of this reduced rate of tax. And for section 115BA, there is form number 10IB, that is tax on income on certain domestic companies. For section 115BAA, there is form number 10IC. If you look at the forms, they are very simple, easy, and they have to be digitally signed or to be verified by an OTP. However, they have to be intimated in advance. There is quite possible that there might be a difference between the tax audit filing, and in between company may want to switch to another scheme, or company may not have, assessees may not have opted for this reduced rate of tax for whatever reason, and after tax audit has been uploaded, they want to switch to this reduced rate tax scheme. Whether it is possible? Yes, it is possible. Even if you have filed your tax audit report and thereafter you want to switch to this system, you have to just fill up the forms, keep a tab of the date and time when your tax audit report is uploaded, and date and time when you have opted for these schemes, and file your returns accordingly. And not to have any ambiguity, I have shared in a slide that you should obtain an acknowledgement so that there is no ambiguity and assessee chooses his option before filing of ITR itself. However, Act is very clear, assessee's option is to be exercised before filing of return and not before filing of tax audit report. And therefore, assessee has a right to switch his choices before filing his return of income. Now, next change is at clause number 18, which is related to the same changes which are there in form number at clause number 8. These are consequential changes. This being the first year, there will be reporting of certain transactions for the first time, and they may not be applicable in the next year onwards. These clauses are not applicable to all the assessees, but only to those assessees which has selected The reduced rate tax regime. Clause 18 पे. Clause 18CA is applicable to those assessees who has opted for application of section 115BAA. In their case, application is summarized below. The domestic company could be engaged in any business or profession. Domestic company has not claimed deduction under the provisions of following sections, which is already there are various sections where either there is a special treatment for expenses or there is a special treatment for newly established unit. So there should not be double benefit of reduced rate of tax and reduced income. And therefore, if assessee is selecting reduced rate of tax, then section AA deduction for establishing new unit in SEZ or additional depreciation under section 32(1)(2)(a), backward area incentives under section 32(a)(d), deposit scheme under section 33(a)(b). See, all these sections are very specific and related to a specified category of assessees. To all our chartered accountant friends, it may not have any value specifically because we may not be dealing with tea plantation companies. But at the same time, being in the profession, we should be aware about what are the changes and where they are applicable. I am hopeful that every one of us will someday or another get these kind of clients who are engaged in mining activities. Though in Bombay, finding any company which is engaged in mining activity is difficult. We might find it in Madhya Pradesh or maybe in Goa. Important is, under any provision of chapter 6A under the heading C, no deductions can be claimed. Deduction in respect of certain incomes other than profession provisions of section 80JAA and recently ATM has been added. ATM, as we know, dividend has become taxable income, and therefore if a company receives dividend income and in turn declares a dividend, then to the extent of dividend received, any dividend paid is deductible under section ATM. It's an old provision which was withdrawn after dividend become an exempt income, and now it has been reintroduced when dividend has become a taxable income. There is a specific reporting requirement for these provisions. So you will have to mention the description of the block of assets, class of assets, rate of depreciation, opening WDV or actual cost, adjustments made to the written down value under section 115BAA for assessment year 2021 only, adjusted written down value. So if any additional depreciation has been claimed or benefits has been taken, you will have to surrender it before you move on to the reduced tax regime. Our liability as a tax auditor is to do a reporting. However, we have to understand that this reporting will be picked up by assessing officers, and most probably when we are into faceless system, no one will apply their mind. It will be the computers and softwares who will be applying their mind and doing the things. So we have seen at various times that when we report certain expenses which are disallowable under 3CD report, they are automatically picked up when the CPC does their arithmetic and gives a report under 143(1)(a). And the assessee in turn has also offer it as a disallowance, and there is double disallowance, once through 3CD report and another through assessee's computation and his offering. So we should try to avoid this type of double reporting if something has already been computed. The problem is that we are very much comfortable with manual calculation of computation of total income, and sometimes we forget to compare it with the forms or online computation forms which has been filled up, and when tax calculation is done by the system itself. So the ideal situation is always have your printouts ready in hand before you start even filing the income tax returns online, and always compare that your total taxable income and total tax liability matches with the printouts in your hand. We rely sometimes too much on computer generated output and forget that our mathematics in hand is much better than what that system is doing. System is following a different logic, and we are not yet accustomed to that following of that logic, and therefore we should always be in a comparative mode. Section 32A has been amended. Clause 32A has been amended to suit for, again, there are three ways in which the department is collecting information in form 3CD. One is the reporting per se, where we don't have to give any opinion. There is some class of reporting where our opinion is involved, the way Piyush Bhai has said that disallowance under section 14A, whether we should report it or we should not report it, or how much we should calculate it. In my view, if assessee has chosen not to do anything, and if there is an exempt income, it is our duty to apply our mind as a professional. We are doing a semi-judicial function over here. We are helping an assessing officer to form a primary view, and on that basis we should calculate and offer in our tax audit report, in our professional opinion, what could be classified as an expenditure relatable to this exempt income. And if we are unable to form an opinion based on whatever information available to us, then we also can go to Rule 8D and take help of Rule 8D, because again it is a collective wisdom of the authorities which has come in way of a rule to assist the assessing officer, and whatever is available to assessing officer is definitely available to us as our as a tax auditor of that particular assessee. So 32A requires us to report details of brought forward losses and depreciation allowance, serial number, assessment year, nature of losses and allowances. So business is a loss and depreciation is an allowance. Amount, return. If the assessed depreciation is less and no appeal pending, then you have to take assessed. If there is appeals pending, then you will have to take whatever is decided in appeal. All losses and allowances not allowed under section 115BA has to be reported. Amount adjusted by withdrawal of additional depreciation on account of opting for taxation under section 115BA. As we have seen that I will go back to the slide. In clause B, additional depreciation for new plant and machinery at the rate of 20% or 35% in specified backward areas. Now, if somebody has claimed this additional depreciation, then the same needs to be withdrawn for taking advantage of reduced rate of taxes. And this is an one-time exercise which the auditor has to verify, certify, and accordingly modify the block of assets as per income tax return. Again, it has to be listed assessment year wise. We are aware that business losses can be carried forward for 8 assessment years, and depreciation can be carried forward indefinitely. So if there are losses to be reported, then it should be reported only for those 8 years and not more than that, because thereafter there are no more losses to be carried forward. Information has to be given assessment year wise, and these will be applicable only if you have selected reduced tax rates at clause 8A in form 3CD. You have filed the forms 10IB, 10IC before you have started filing your income tax return or tax audit report. Now part C talks about specified domestic companies, and serial number 22 and the entries relating thereto has been omitted. There is renumbering of clauses and a new clause has been introduced. So now serial number 22 previously read particulars in respect of transaction in the nature of any expenditure has the SSC entered into specified domestic transaction, being any expenditure in respect of which payment has been made or is to be made any person referred to in section 48 2B. Serial number 23 and 24 are now renumbered as serial number 22 and 23. Section 23 talks about acquisition of any goods and services, and 24 talks about particulars in respect of specified domestic transaction in the nature of any business transacted. And there is a new clause particulars in respect of specified domestic transactions in the nature of any business transacted between the persons referred to in subsection 6 of section 115 BAB and reporting with respect to it. You have to mention the name of the person, specified domestic transaction, description of the transaction including quantitative details, total amount received, receivable, paid or payable in the transaction as per books of accounts as computed by the SSC having regard to arm's length price. And for arms calculation of arm's length price, you have to refer to section 92C(1). It is very important which method of calculation of arm's length price is being resorted to. Maintain your working papers. Sometimes it is impossible to have a uncontrolled price method because all the transactions which are related to are always through related party transaction, even if they are in public domain. So you might have to go to another method just because comparables are not there. And see, as an auditor, we know that these provisions are not new. Even in Companies Act, there was always reporting whether transaction which are being done with related parties of directors and they are not prejudicial to the interest of the company. The only wording changes whenever you find whether they are prejudicial to the interest of the company or not. You have always gone and verified the transaction with independent party. If it matches with independent parties transaction, the valuation of it, and then you say it is not prejudicial to the interest of the company. Similarly, in taxation, instead of using those wording, we use something very technical which is called as arm's length price. This was as far as the amendments are concerned. So if anyone has any questions, kindly let me know and I will try to resolve those issues to the extent possible. Apart from that, the main focus area always has to be on the perspective of doing tax audit. हेलो मिश्रा जी, कोई क्वेश्चन?
सर दिया।
क्वेश्चन नंबर 1, 2 नहीं दिख रहा है मुझे।
क्वेश्चन 3 से है सर।
अच्छा, क्वेश्चन 3 से ही चालू हो रहा है।
हाँ सर।
An assessee is filing return under presumptive income 44 ADA. However, his bank statements, the withdrawal are not enough to support the 50% expenses. Do he need to give the higher income, and his department has right to call for the bank statements and verify, since under presumptive income no books of accounts are required to be kept? So there are 2 or 3 questions put together in this particular one question. One is whether I should declare higher income because there are no enough withdrawals to justify the expenditure of 50%. No, you are not required to do that. Government considers that 50% is a reasonable income, and if you are offering that to tax, then no further books of accounts is required. Do he need to give the higher income? Answer is no. There is no need. Department has a right to call for a bank statement. Yes, department has a right to call for bank statement, and they can call it directly from banks, because at the end of it, they have to verify the gross receipts. And if you are not maintaining your books of accounts, on what basis one is going to justify gross receipts? And therefore bank statements can be rightly called in. However, as I said, the all expenditure need not come through bank. It can come through loans, it can come through past capital, it can come through various sources. And since you are not maintaining books of accounts, you are not obliged to provide the books of accounts, and therefore you can offer 50% and relax. Most of the time I'm also doing that. So obviously only those people will select 50% presumptive taxation whose actual profit is more than 50%. If somebody is having less than 50%, they are chartered accountants, and their fellow brothers are already practicing, and definitely getting a tax audit report for CA firm or loyal firm is not that difficult a task, because these are educated professionals. Even if doctors and architects, or we consider other professionals, definitely they are educated people, and for them maintaining books of accounts and getting audited is not a big challenge. And therefore nobody will pay 50% unless they have a genuine income of more than 50%. It is given, right? So we move to another question. Question number 4. Cash received
हेलो
on, yes,
हेलो सर,
हाँ
फर्स्ट से
बोलिए।
लीजिए सर फर्स्ट से
अच्छा,
लीजिए
आपने
सर।
बोला थर्ड से, तो मैं थर्ड से आगे जा रहा था।
हाँ सर।
Please explain the adjustment to be made to opening WDV in terms of proviso to section 115B AAA in relation to additional depreciation. Does it mean that any unabsorbed additional depreciation which is disallowed due to opting of 115B AA should be added to WDV as on? Yes, the answer is yes. That is the adjustment is what is required, and that is a precise purpose for which they are calling in for those details. You will have to do the adjustments. That has to be added back. A partnership firm, question number 2. A partnership firm construction activity having turnover of less than 50 lakh in AY 2021, filing ITR 5 since last 8 years. However, the turnover of all the previous 3 years was less than 50 lakhs. Then too, the assessee filed tax audit report as net profit was less than 8%. A partnership firm construction activity having turnover less than 50 lakhs. I think the question is getting repeated. Is tax audit applicable to be filed for current year 2021. See, when we are doing tax audit, what is past is immaterial. The slide is there. You have to see whether he is following presumptive taxation, yes or no. If in last he has opted for presumptive taxation and current year he is not offering in presumptive taxation, yes, he will have to do tax audit. If he is in presumptive taxation and wants to report a profit which is less than the 8% presumptive tax rate, yes, he will have to do tax audit. And as I said, whenever in doubt, tax audit is compulsory, because doing tax audit, there is no penalty. Is a revenue source for chartered accountants, and I'm always there for revenue generation for chartered accountants. I hope that this issue is resolved. Question number 4. Cash received on online sale made through Amazon, Flipkart, Snapdeal, etc. as cash on delivery, whether to be considered for 5% cash transaction. Cash received on online sale made through is cash delivery, whether considered for there is a specific provision for online sale transaction, and for them this 5% will not be applicable, because the payment mechanism is different when we come to Amazon, Flipkart or Snapdeals. Stockbroking transaction routed through one of my colleague and commission received for gross transaction. As previous speaker said, there is no presumptive for commission. Is that case, what amount will be considered for applicability of tax audit? Stock broking transaction routed, always whenever you have to consider gross receipts or turnover of business, the method of accounting employed by the particular broker will be important, and the guidance note on tax audit is very specific on this, that if something has been routed through profit and loss account, even if it is whether it is GST or it is your commission, so there is transactions where stockbroker shows the purchase and sale of securities and difference as their commission. So I am unable to understand how the accounting in this particular question is, but if that is the way in which I say that all purchases and sales are routed through profit and loss account and difference is my commission, then turnover will be calculated on the basis of sale of those securities. And if only commission is routed to profit and loss account, then basis of commission it will be turnover or gross receipts will be calculated. Question number 6, whether other income like interest earned on investing surplus business funds is to be considered while airing limit of tax audit, and will these be part of gross receipt? Yes, if it is related to business, it will be part of gross receipts. If it is not related to business and an independent activity in itself, then it will not be considered for the purpose of calculation of turnover limit. And in past, you will have to go and check what way this gross receipt has been shown. If interest has been shown as a business income, then yes, it has to be considered. If interest has been shown as income from other sources, then it should not be considered. Same goes for dividends in case of share trading activities. So dividend may be considered as a business receipt and offered as a business income. So depending on your past, you will have to do this, or you will have to take a stand for when you are doing it first time. Question number 7. For section 115B AA, deduction was not allowed for chapter 6A under heading C when the section was introduced, which means that deduction under section 80G can be claimed for financial year 1920. Please clarify, as the section was amended in finance budget 2020, wherein deduction can be availed only for section 80IAA and 80JAA. See, it is very simple. You have to select an option for reduced rate of tax before filing your income tax return. And therefore, what you have done in financial year is immaterial. What you have done in the 6 months of assessment year is immaterial. You have choice now. compute your taxable income as per your old provisions, compute your taxable income as per 115BAA, consider which one is more beneficial to you, which one is going to be beneficial in future also, and thereafter select your choice. Question number 8. Is the change in schema only for corporate assessee or is it applicable to cooperative societies, AOP, etc.? Change of schema is applicable to forms. It is immaterial whether it is for which assessee. You will have to file the form with new schema. A company adopting option under section 115BAA, the company has claimed additional depreciation till 1920. What adjustment to be made? We have already discussed. He will.
सर क्वेश्चन नंबर 9 है सर.
अच्छा, तो स्क्रीन में जो दिखता है मैं उसके हिसाब से जाता हूँ. एक्सक्यूज मी, आई विल गो टू क्वेश्चन नंबर.
क्वेश्चन कॉपी करने में आगे पीछे हो गया सर. क्वेश्चन नंबर 9.
हाँ, so my 5-year 44 AD limit is completed and I am under 5 crore. My cash payments are not more than 5%. Do I have a compulsion? No, if you have completed your 5 years as per the sections, now you are a free man, free bird. You can make your free choices. If you want, you can go for 44 AD. If you do not want, you can go for normal taxation. Okay, prepare your books of accounts and do tax audit. Otherwise, you can always go in for 44 AD limit, whichever is more beneficial to you. Question number 10. EPF employee contribution paid before filing IT return but paid after due date as per PF Act is being disallowed by CPC. Yes, but there are case laws. There are two opinions. What is your view and what can we do to help the client? See, when it comes to tax audit report, forget about helping client, because otherwise you might be held professionally negligent. Unless and until there is a binding judgment from the jurisdiction in which you are operating and there is no contrary view, you should go with that. Otherwise, follow what Act says. As far as we are concerned, we have to just report the delay and number of days it has been delayed. To allow or disallow is something which CPC has to do. Once we have reported the delay, CPC will automatically disallow it and assessee will have to fight it out by way of an appeal. Question number 11. A company adopting option under section, the company claim additional depreciation. What adjustment? We have already considered. He will have to surrender whatever additional benefit they have gone under the previous sections and then go for reduced rate of tax. Interest on TDS to be reported, whether is actual interest paid during the financial year or for the financial year. Now consider this, because there are, whenever for each clause in form 3CD, there are n number of decisions and n number of consequences. Whenever you are reporting for TDS, you have to keep a tab of what are the penal provisions if TDS has not been deducted in time, deducted but not deposited in time, and what are the CBDT circulars for penalties and prosecutions. So there is a circular of CBDT which says that if the TDS deducted but deposited late is less than 25 lakh rupees and delay is less than 60 days, then prosecution will not be launched. So this gives us an idea of what are the scenarios which our assessee is going to suffer because of our reporting and because of his mistakes. We have to highlight him, we have to prepare him, and before any action or show cause notice is taken up by income tax department, we can suo moto go and settle down those issues. There are provisions in laws. So interest on TDS to be reported, yes. Whether it is actual interest paid during the financial year, it is always related to those TDSs for which you are doing a reporting. So if there is a delay, because otherwise there is a different reporting somewhere else in the form. When we are discussing about the TDS chart, date of deduction, date of payment, and you are generally saying that yes, TDS provision are generally followed. What does that generally followed means is that assessee has paid interest and regularized the delay, and therefore that interest is to be reported. If there are other interest also, then they are PYT transactions, and you will have to report it at different places. I hope that I was able to assist you all in my limited way to understand what Form 3CD is all about and what are our liabilities towards assessee and towards income tax department. If there are other queries, you can always reach out to me, and definitely ICAI forum is there where we can take out our queries. I'm just praying to God, though I don't have to, I have no authority to sign any tax audit report, but I pray to God that by a couple of days we will get our extension. And as Piyush Bhai has said, that maybe it should be 20th February or 31st March, so that we don't have to bother about month ends anymore till this COVID situation improves. So stay fit, take care of everyone, and thank you very much. Oh, Mishra ji, yeah, are you suggesting there is another questions downside?
Again, a question.
Okay. So suppose professional gross receipt is less than 50 lakhs and he offers 50% of it to tax, but not opting to choose the option 44D. Is that correct? No, it is not correct. There is a way of doing things. So when you follow a law, you have to follow the procedure prescribed under the law. If you are opting for 44 ADA, then you have to specifically mention. If you are not opting and offering higher profits, you are making yourself vulnerable that your scrutiny assessment can be done. So I am thinking that this is a challenging question when it is exactly 50%. My book profit and my 44 ADA both are equal in numbers, and therefore it is immaterial whether I follow this or that. No, there is a difference, because for 44 ADA there is a presumption you don't have to maintain your books of accounts. But if you are offering 50% and not choosing 44 ADA, then that means you have books of accounts and you will be subjected to scrutiny assessment and consequences which will follow. Is deduction under 80G is available for financial year 1920 if 115 BAE is opted? If I will have to check whether 80G follows under chapter C of chapter 6A, section 80C, 80G. So if it is under clause C, then no deduction will be available if you are opting for 115BAA. Or chapter 3. So in my view, 80G is not available if you are following 115BAA. If carried forward losses are there, you will be allowed to claim the benefit of section 115BAA. There is no issue about it. The only concern of tax department is that you are not claiming certain benefits twice, that you are claiming the benefits available for higher depreciation, benefits of backward area, benefit of SEZ, and again coming and claiming benefit of lower taxes. That double should not be there. If you have brought forward losses, I am reading it brought forward, though it is written as carried forward losses. So if you are having brought forward losses, that claim will continue. So interesting addition to it is, then the section was introduced, the same was available, and only now the same has been amended. How to deal with the same? So when logic ends, law begins. So we have to follow the law as on the date on which we are filing our tax audit report. Professional maintaining regular books, can he shift to 40 ADA? Yes, he can shift to 44. Rather, 44 ADA is only for professionals. So government is aware that you are a chartered accountant, you are a law professional, you are any other professional for which specific books of accounts has been prescribed to be maintained. And then there is a overriding thing that if you are following 44 ADA, then books of accounts for the purpose of profession is not required to be maintained. For all other incomes and expenditures, there will be books of accounts. So if you are having income from house property, if you are having income from other sources, for those, whatever records you are maintaining, you are supposed to maintain. But when it comes to your professional income, 44 ADA will have overriding effect, and assessing officer will not have any right to inspect your books of account for a limited purpose of calculating your gross profit or gross professional receipt. Sorry, gross professional receipt. Definitely you will have to prove that your professional receipt is less than 50 lakh rupees, and whatever amount you have considered as your gross professional receipts, on which 50% you have calculated. So those in figures you will have to justify, and to that limited extent you will have to maintain books of accounts. Can a partner in a CA firm take advantage of 44 ADA? Now there is an interesting question and interesting theory behind this. I don't know why the person who is asking the question is asking in this way, but can I apply 44 ADA for my remuneration from partnership firm and interest on capital? Because per se, except for membership fees and profession tax, there are no other expenses to be claimed for these two things. And I see no reason whatsoever to apply 44 ADA to remuneration from partnership firm and interest on capital and any other income which the professional may have. To, in my humble view, if a partner in CA firm is drawing remuneration from partnership firm, then definitely for his professional receipts, he can take advantage of 44 ADA and pay only 50, declare only 50% of those incomes taxable under the head profit and gains of business and profession, and file his income tax return. I have MAT credit once I move to 115BAA. This credit is unavailable now. Secondly, the brought forward losses as on March 31, 2019, the ITR can be used to offset future income. I'm unable to understand this question. As regards MAT credit, it is unavailable if you opt for 115BAA. So while making a choice between whether I should go for regular taxation or I should go for 115BAA, these issues needs to be resolved. And here the practitioner has to help his assessee, his client, to decide which option is better for him, considering the past and the future. So somebody is asking to repeat answer to question number 19 again, and here it is, can a partner in CA firm take advantage of 44 ADA? So I am reading it. Can a CA firm partner opt for 44 ADA? Yes, he can opt for 44 ADA. There is no advantage the way it has been described, but yes, we can take benefit of 44 ADA, and all the professional income which is taxable under the head profits and gains for business and business or profession will be available to the CA firm partner, and he can opt for section 44 ADA and offer the remuneration received from partnership firm, the interest on capital, or any other professional receipts by claiming section 44 ADA. So in somebody's opinion, ATG shall be available even if we opt for 115BAA, as the same was amended with effect from 1/4/2020. Now what we have to see is 1/4/2020 is assessment year or financial year. And in my opinion, it is assessment year. So the moment you say it is amended from 1/4/2020 assessment year, by default previous year is 1920. Please provide the circular no due to which the TAR filed 1st October it will be having no effect. So notification number 33 of 2014. So those interested may type it down or write it down. It is notification number 33 of 2014, available in income tax portal. One can download it. It specifically provides that if there is a modification of any form, etc., till the time the new forms has been released, no uploading is required to be done. Are godowns where no books or documents maintained need to be mentioned in Form 3CB? Yes, godowns has to be mentioned. Books of accounts are always kept at either registered office or principal place of business, and godown is a branch. And you may say that there are no books of accounts maintained, but definitely you will be maintaining the godown receipts, godown inward, godown outward, and godown stock register. These are part and parcel of books of accounts, and they are primarily kept over there. Apart from that, even your bin cards or dockets which you maintain at godowns, they are part and parcel of books of accounts, and therefore it has to be reported. Can you please explain adjustment with an example? Adjustment to WDV on 1419 with an example. So what I can do is I can ask Mishra ji to share the example. Right now I am not carrying an example with me, and we are at 12:52, 8 minutes to the deadline. So I will prefer if we can focus on the questions which we need to understand. Let's understand that WDV adjustment is simple. It is just because you have not done it, you may find it difficult. ATG falls under chapter 4. So that's what I said, that chapter 6C is where disallowances are there. Chapter 6B, so they have either knowing the answer and testing my knowledge. So for the benefit of all of you, I will read out that ATG falls under chapter 6B and not 6C, and therefore donations will be allowed under section 115BAA. A CA in job not holding COP can take advantage. I don't know why we are asking about advantage. These are schemes of law. There is nothing advantageous or disadvantageous. Either you follow it or you don't follow it. Now, considering to a CA in job, if he is not holding COP, then whether he is having any income from business and profession, and typically when we are talking about professional, whether he is a professional in a sense in which Income Tax Act looks at him, And if he is not holding any COP, can he have professional income when he is a member of CA Institute, and whether professional ethics permits him? There are too many questions involved, and it is not a right forum to even ask this question or answer this question. You may always privately contact me, but not good question for the forum at which we are right now. There will be a disciplinary action if I start to answer these questions. Sir, doesn't the object of the government and CBDT is defected in a small business having 0 to 2 crore need to be audited, and business turnover 2 to 5 crore need not audited? Let us understand, it was demonetization, and the policy of government is to do all transactions through banking channel. And if you are doing it, there is a bright possibility that because of increased softwares and access to data, you will be caught today or tomorrow. So chances of committing frauds or chances of evading taxes is negligible. And one may look at that 0 to 2 crores need to be audited and 2 to 5 crore need not be audited, because 2 to 5 crore, the possibility is it is audited multiple times and therefore may not require the re-audit, provided when 100% or 95% of its payments and receipts both are routed through banking channels. And yes, it might look differently, but it is in aligned with the objective of the government and CBDT, that instead of focusing on small clients, let chartered accountant do the work, and where big clients are there which are multiple times audited, let give them liberty, provided they are routing their transaction to banking channels. I don't see any disalignment over there. And don't suggest to government not to audit the clients of 0 to 2 crore, otherwise lot of us will lose business. So we are not interested in that. Rather, even 2 to 5 crores, the limit of 5% should be reduced to 2%, so that more of us can get the work. So question 29, income on intraday trades, non-delivery, entered into by proprietary trading stockbroker, can this be claimed as non-speculative business income, as there are various case laws with different opinions? As I said, case laws, only Supreme Court case law has an effect of being a law because of Article 141 of Constitution of India. All other law cases are challengeable if there is a favorable case law of your own jurisdictional high court. In our case, Bombay High Court, then yes, definitely we should be abiding by that. Otherwise, we will be doing a contempt of court. So let us follow Bombay High Court judgment if it is available there. And intraday trades are always speculative whenever they are non-delivery. This is a deeming provision. And therefore, in my humble view, that I will prefer to claim it as a speculative and go ahead with that. Interesting thing is to note, because of this I have come to something this, there are lot many salaried people who are engaged in derivatives and options trading, because maybe they have some spare time at office, they have internet connection and they have money to play around with, and what they forget is that the forward and options transactions, derivative transactions, because of a deeming fiction, are treated as a business income and not a speculative income. And to those transactions, the provisions of presumptive taxation might be applicable. And if there are losses, which in most of the cases are losses only, then they are supposed to get their books of accounts audited. Now, here is an opportunity for those salaried class persons audit to be accounted, because they are dealing in derivatives transactions. Income Tax Department in past has issued notices to various assessees for not filing tax audit report. And yes, they are generating work for me as well through litigation. is the amendment section 44AB limit of 5 crore is only for registered MSME or even non-MSME business too? It is for both. It is for SSEs, whether they are MSME or non-MSME, provided the criteria specified in that section is met. How can a partner offer income under section 44 ADA when remuneration received by him will be exempt in his hands and taxable in the hands of firm? Request you to kindly clarify my doubt. Thank you. Okay. So there is a limit on which remuneration can be exempt in the hands of a partner, and those limits are specified. There are conditions which specify that the remuneration has to be approved in and specified in the partnership deed, and whenever there is change in that partnership deed, in the first year after the change in partnership deed, that partnership deed should be submitted to your assessing officer along with your return of income. Now, if you look at it, there is every possibility that the remuneration which is actually received might become taxable in the hands of a partner because the condition specified in that section is not met. And therefore, there is a window open for taking advantage, so to say, or opting for presumptive taxation. Question 32. A domestic company which opted to pay concessional rate of tax under section 115 BAA and section 115 BAB is allowed to claim deduction under section 80G by Finance Act 2020. Vishaji thoda upar. 2020 from AY 21-22. This is applicable for financial year 1920. And from AY 21-22, such a company cannot claim deduction under section 80G as per the amendment by Finance Act 2020, because this ambiguity, the question was raised. Okay, this is a clarification and not a question. Question number 33, PNM, additional depreciation 20% of last year. Calculation lo. On additions made after 3/10/2019 was taken at 10%. That is half the rate, because 10% depreciation for 11 FY 18-19 should be foregone simply in financial year 1920 depreciation calculation, or it should be added to opening WDV, or it should be reduced from opening WDV on PNM in financial 19. SSC opts for 15 BA. Now understand, when we come to depreciation, there is something called as block of asset method, and when we are recalculating these things, the block of asset method simply says that opening WDV, addition during the year, deletions, depreciation actually allowed in the assessment. When you do arithmetic of this, you come at closing WDV. So if any one of the figures is changing, automatically there is a effect on your closing WDV. And yes, if you are not claiming something or you are claiming additional something, there has to be adjustment with your closing WDV, and therefore you will have to do this arithmetic. Is someone having proprietary business providing consultancy related to technical services, but proprietor is not engineering profession, can proprietor opt for 44 AD, or he has to opt for ADA? Now understand, when we say professional, the term professional has been defined. There are licensed engineers, architects, advocates, chartered accountants. These are professionals. But actors, thereafter government valuers, the diamond valuers and jewelry valuers, they are also professionals. They are having a specified skill set to do that particular transaction, which is not available with others. So if you are carrying out any technical consultancy which gives you exceptional knowledge in that particular field. For example, say you are a chemical plant designing expert and very technical in that sense. Yes, your consultancy, if it is related to that field, can be considered for the purpose of definition of professional. But if you are saying that you are doing a loan syndication work or any other such kind of a technical service, and that consultancy services is there, and your qualification or skill set is BCom or any other graduate, then no, you are not eligible for opting under 44 ADA. You will have to go for normal business under 44 AD.
Excellent session, Manoj, and really you have covered more approximately 34 questions, and answering such a 34 question is not a joke which are coming up front. So really a great work you have done. So we have with us CA Malvika Mitra, and now I request her to kindly propose a well-deserved vote of thanks to Manoj. So the session was really very much enriching, Manoj.
Thank you very much for this opportunity, because the most I like is the way questions are thrown at me, because that is a learning exercise for me. Having an audience of 200 and odd number of chartered accountants throwing questions, I think 34 is still a small number. I was prepared to go for 100 or 150 questions, but maybe the session timing doesn't permit it, and Mishraji is doing some scrutiny of reducing the repeat number of questions, and therefore it is smaller number. But always the way people are, I consider that these are brainstorming sessions. You take something, I take something. For me, your questions is the valued input which I take from these sessions.
Yeah, over to you, Malvika.
Yes, yes, it was very, very interesting. As Manish has rightly mentioned, 34 questions. I was saying, ये main sheet हो गई थी हमारे लिए. But very important was, we were talking about depreciation, but I personally felt this was more like an appreciation to all of us, appreciating our, knowledge. The depreciation was really appreciating our knowledge, but very clear, very, very clarity on depreciation, too much of clarity on who should be audited, especially the professionals, especially we're concerned about us also. So I think that was a very, very complete session in all the legal parts. So thank you very much, Manoj ji. Thank you, Manish ji, for coordinating everything. And see you very often now. We need it.
Sure, sure.
Thank you so much.
Thank you, Manoj ji.
Thank you.
Thank you. Bye-bye.